Hey guys, just want to give you a good welcome here from Benzinga family. We're going to be starting in about 14 minutes or so here with former hedge fund trader Chris Capre. He's going to be with us today, chief educator at the Benzinga Option School. Grand launch, grand debut today. So we're going to be starting here in a little while, guys. Stick around. What up, everybody? How are you guys doing? We are going to start here in a couple of minutes now. And just for those that are in the chat, Tomas, MVST, Tilray, I see those. Um, Welcome to today's session, guys. We have something very special planned for today. And this is going to be with Chris Capre, Chief Educator at the Benzinga Option School. This is the grand debut, of course. So good stuff, guys. I appreciate the energy in the chat. Love it. So S&P all-time high, guys. We're going to talk about the markets, options, a lot more here with Chris Capre. I believe that he is already in the house. If he can give me the green light, let me know. Let me know, Chris, when you are good to go.
Yes, I'm here.
Hello, man. How are you doing, Chris?
Very good. How about you? Happy holidays.
Happy holidays to you, man. How's it been?
It's been good. We're getting a lot of snow here. We've had about 190 inches on the mountain in this last month, and so quite a lot. Just this last week, we probably got close to 8 feet. So yeah, good times. Looking forward to getting on the slopes.
All right. Well, that's good to hear, man. Good to hear that things are going like that here. And Sakar, Joe, Hermie, welcome, guys. Welcome. Chris, feel free to go ahead and take over the screen. I know you're having a great session planned here. It would be good to know, guys, in the chat, if you can let us know. Give us a 1 in the chat if this is your first time here, and give us a 2 if you've already been here before with Chris.
Okay, I'm going to start with some video here. Just a second, and bam.
Bunch of ones. Bunch of ones. 0. What does 0 mean, Matt? Let me know. Bunch of ones, Chris. So, okay, great. So for those that, it looks like everybody here is on the one side. So, Chris, I'm already familiar with your background, but if you don't mind giving us a brief introduction of your experience on Wall Street, performance and all of that, since there are many folks here who haven't been to any of your sessions in the past.
Sure. So, hi, everybody. Happy holidays. Chris Capre here. So I have been trading for 21 years professionally. I was a former broker on Wall Street for FXCM, and I did that for 2 years. And then after that, I traded for a hedge fund, the JNF hedge fund, for a year. And while I was at the brokerage and also at the hedge fund, I was also asked to teach some classes to some of the employees, to some of the clients. And then when I was at the hedge fund, I was also asked to teach classes to the new trainees. And so I've been teaching for almost 17 years now, while trading professionally for 21 years. And so, sorry, a little noise in the background there. Sorry about that. I'm not sure if that's you or me. Anyways, so with that being said, I have a fair amount of experience. You know, I've traded through the .com boom and bust. I traded through the GFC, Great Financial Crisis of 07, 09. And, you know, trade through COVID. We had, you know, some pretty interesting markets. You had the flash crash, all these things. I've traded through a lot. Trade through 3 different central bankers with the Fed. You know, some people weren't even trading, let alone investing in markets when, you know, Greenspan was around. And so I've seen a lot. I've seen it all. I've traded through multiple asset classes, from FX to stocks to commodities to indices to bonds and options. And so I've spent, you know, years now learning options and really diving into it. And, you know, my institutional experience has really given me a way to see the market from the inside out. And that's kind of the approach I take to the markets. So yeah, that's pretty much it. Put a 1 in the chat, by the way, if you can see this introduction to options trading principles PowerPoint. Very good. Nice. Okay, appreciate it, Zoom, and also checking in with my YouTube followers. Good to see everybody here. Options sounds like gambling. So Oliver, when we're done with this, you're going to see how options trading is not like gambling if you learn what you're doing. If you don't know what you're doing, then I think that's an accurate statement. But if you do know what you're doing and you learn the core principles that we're going to teach here today, then it shifts from becoming gambling to much more using probabilities in your favor, or looking for strategies, or using edges in your favor, using information. And so we're going to shift that perspective so that by the time you're done with this webinar, you'll have a very different perspective about options trading. Why can't I hear anything? I don't know. You probably want to log on, log back in. It seems like everybody can hear me just fine. Okay. So with that being said, I want to get into real briefly my approach to options, my approach to the markets as a whole, and how you can understand options from the ground up. So I've already gone over my experience here. I'm also a verified profitable trader. We shared our results for 2020, and we're going to share them. And I was profitable of the year, about 63% accuracy. We did about a 72% return. And you can see that I controlled risk really, really well, very steady equity curve. We're going to share results at the end of this year for 2021. I made money, not as much as last year because last year was a great year, but I still made money this year and had a strong trading year. And so that means I'm a verified profitable trader. We have verified these results and through a third party, and it shows that I make money trading. So with that being said, I've gone over all this here. So I want to talk about my kind of core approach to understanding options. And so, and I want to start off with my overall meta approach to the markets as a whole. And so as a broker, I got to see various strategies, various types of traders. I got to see everything from, the craziest retail traders to the most sophisticated professional traders and everything in between. And the one thing that I learned is that it doesn't really matter whether you watching and have been trading thus far, whether you're a technical trader. So do you make all your decisions based upon charts and indicators and patterns? Or maybe you're a fundamental trader. Maybe you look at earnings and, macro events and sales and revenue and things like that. Maybe you are a sentiment trader. You're watching Wall Street bets to see what they're kind of looking at, what they're not looking at, see if that will influence the market. Or maybe you're a flow trader. Maybe you're looking at short interest or whatever. The thing about it is that it doesn't matter which one of those four traders you are, technical, fundamental, sentiment, or flow. The bottom line is all of you, regardless of what information you're using, have to make a decision. And that decision is to make a trade in the market or not. And if you make a trade in the market or not, all that information gets correlated into one common variable, an actual order. And when an order gets activated, it's called actualized order flow. It's the flow of all the orders that get activated. And that sum total, that collective activity between all the buying and selling, all the calls and puts being bought or sold, all the long or stock trades or short stock trades or whatever, it doesn't matter whether it's technical or fundamental or sentiment or flow based, they all become one thing, order flow. And statistically, order flow is the most proximate driver of price action. So when you look at the charts and you see the charts moving up or down, it doesn't matter what the information was behind those trades that caused it to move up or down. The bottom line is that it did because of the dominant order flow. If the market is all buying Apple stock on the day, it's like 80% of the traders are buying Apple stock and they're doing it in large numbers, Apple's going to go up. That's order flow. If they're selling Apple very aggressively on the day, it doesn't matter if there's good news or good earnings or whatever, Apple's going to go down. That's how order flow works. And so it's important that you understand this kind of core principle right here, how order flow is the most proximate driver of price action. Once you understand that, then we can move on to the next point, which is that when it comes to the options market, and we're going to show you later on with some statistics, that option dealers and market makers are the most active players out there. And considering that options volumes are through the roof right now, that means that options and option dealers and market makers are having an outsized impact upon the market. And so to explain just in a very rough but simple way how option dealers are active, if I look to buy, let's say 100 calls on Apple stock, let's say I want to buy the 150 calls for whatever expiry in the future. Well, there has to be a dealer or market maker who's going to take that trade. They're going to take that transaction. And so if I buy 100 calls on Apple, the dealer is now short 100 calls of Apple. They're on the opposite side of that trade. Dealers don't want to be exposed to directional risk. They want to make markets, collect their spread fees, move on, regardless of whether the market moves up or down. And so what happens is I buy 100 calls on Apple. Dealers are short 100 calls on Apple. So they're going to immediately hedge that risk. This is called delta hedging. They're going to hedge the risk based upon the delta exposure that they have. And then they're going to buy Apple stock because their exposure is to the upside if they're short calls on Apple. And so because of that, dealers are active anytime the options market, by fulfilling the options market, by making these trades, they are incredibly active. And all this is done algorithmically. Now, keep in mind, that's only one set of activity for the option dealers and market makers. Apple stock price is going to go up or down. And as it goes up or down, as volatility increases or increases, as time goes on, they're going to adjust their hedging activities. So they're very active in the markets throughout the day. And since options volume right now is in the most dominant place it's ever been in its history, it's very important that you learn how options activity and option flows moves the market, and whether the market's going to keep going or not, whether it's going to hit support or resistance and break past it or get stuck. You have to understand that. If you're not understanding that, then you're not understanding one of the most dominant movers in the markets today. So this is this kind of second point here. I talk about dealer activity is reflexive. It's reflexive because that means it's like this reflex, kind of like when you go to the doctor's office and you hit the knee and you like kick your knee out. That's a reflex. That's the same thing in the options market. I buy the calls, they're selling the calls. That's reflexive. Then they're going to hedge that. That's reflexive. So that reflexive action creates this fourth point, predictability. I'm not saying that you're going to have a golden, like this kind of crystal ball, but it does give you information that gives you an idea as to what kind of activity the dealers and market makers have to do in response to all these calls and puts being bought or sold. And that becomes a sense of predictability that you can kind of get an idea as to what's going to happen later today or tomorrow in the options market. So this is kind of the point 4. And to trade options successfully, that means you have to understand option dealer activity. So with that being said, any questions on that before we move on? I was told there would be snacks. Sir Hag, you have to get your own snacks on this one. Or you can trek through all the snow to come get some snacks here, but I'll charge you for them. Okay, let's see here. So check it. Enjoyed the slopes today already. TK1, I'm jealous. I haven't gotten out today, but I'll be getting out this week. Justin's saying, so this is probably going to cover everything basic and nothing advanced. That's not true at all, Justin. We're going to get us some stuff. In fact, I'm willing to bet you probably didn't know a lot about option dealer activity before this webinar. Do you use an option scanner? Yes and no, not so much. I don't really look at option scanners to try and find trades. I already use the Benzinga movers app. The stocks that are moving the most, those are generally the ones that are going to have the best option trades for them. And so I look for that particular scanner in terms of what's moving. Plus, I also have stocks that I'm watching ahead of time. So I don't really use a particular scanner to kind of filter out for this IV or that IV or anything like that. I want to know what's moving because I want to know what has the most dominant flows today. That's going to really give the most idea of what's going on for today. Okay, let's hear. How do we track dealer activity? You can't track dealer activity. You can only speculate on dealer activity at some point, but you can, through understanding open interest, get an idea as to what dealer activity is. How is this different from other option experts? I don't know what other option experts you're talking about, so I can't really answer that question, but I can tell you that probably 7 to 9 out of 10 are not talking about dealer and market gamma and flows. So we'll get it. So as you continue on this webinar, you're going to understand more, but there's a lot of things we're going to be talking about that I've seen pretty much every other option expert out there. And I would say 9 out of 10 don't ever talk about these things. So yeah, hopefully I answer your question, but keep listening and you'll learn more. Okay, so going through the questions, let's go ahead and move on. Okay, so before I'm going to explain some ideas about how I use options and how you can understand options to make money in the markets, I want to talk about what I think is the best way to learn options properly. Now, if you go to YouTube and look up a bunch of videos on options trading, or you go to get books on introduction to options, they're all pretty much the same straightforward approach. They teach you about the basics of the options market, how calls and puts work, which is, pretty straightforward in 1 and 2. They cover this, they cover this. Some of them will cover the Greeks to a limited amount. Very few cover the Greeks in an advanced way. And then they go to stage 4 and they'll say, okay, here's some option strategies. The thing about it is that most stop there. And on top of it, most books or videos on options that you see, they'll just say, hey, if you're mildly bullish, use this option strategy. Or if you're heavily bullish, use this option strategy. But the thing about it is mildly bullish and heavily options bullish is imperfect in 2 very particular ways. One, it doesn't give you a clear understanding of what mildly bullish looks like in the charts, or what does heavily bullish look like in the charts. And that's something that we teach. When we teach option strategies, we first teach you how to use the strategies in the Benzinga Option School, but then we teach you the specific chart, price action, and patterns and structures that you want to match with each strategy. You can't apply each strategy to every type of environment, every type of trend, every type of range, every type of volatility. They all have their own specific uses, and they'll just say, hey, here's when you use this, here's when you use this, but it's very general and broad. We get into specifics in the Benzinga Option School. I literally say, look, these are the chart patterns, these are the structures, this is what you're looking for each strategy. And here's why this strategy works with this pattern. And here's how you leverage it with this strategy. So it's super important that when you learn option strategies, you always combine it with the right price action and technical analysis. Otherwise, you're going to be mismatching strategies for the wrong environment. But then, as I said before, most will stop here and none of them get into this. And as we go through today's presentation, you're going to understand why this has a very important impact upon how the market moves and whether you have the right strategy or the wrong strategy today, tomorrow, and the next day. Let's see here. Where do you delta? Bill, you're going to have to rewrite that question. Where do you delta? You have to help me understand what you mean there. Is this being recorded? So be sent. I don't know if it's being sent out to attendees, but it is being recorded and we will make it available on YouTube for you. That's always my frustration. Yeah, I hear you about that. How do we track the options before it expires? That's open interest. You would have to, there's various ways to do it, but you're going to need a proprietary app or program that's going to tell you which options are expiring. You can look at open interest on your options chain. You can see, hey, here's the open interest at these strikes for these expiries, but that's very laborious. And so it helps to have a proprietary program to do that. I have one. I'm working on building one with Benzinga to do that. Sarah Rodrigo can answer that question. And then NBA has a question. And then Tim has a question. And then I will get to you 2 questions and then we're going to move on. Okay, NBA, your question, we'll get into that a little bit later. And same with you, Tim. Yours is a little bit later. Where do you find the delta on any option trade that's on the option chain? What's a better indicator for options trading? If it is a volume or open interest? Both. You have to understand that each have their own impact. Okay. All right. I feel like I've gotten Tom on YouTube will answer your question in a little bit. Okay. And we'll get to that. All right. So with that being said, I'd like to move forward. Here are the various ways that you can make money in options that you really can't. There's really only one way here that you can make money with stocks in the same way that you can make money with options. If you're going to trade Apple stock, you can really make money 2 ways, maybe 3. You can buy it and it needs to go up. You can sell it if it's going to go down. Or if they have a dividend, then you can make money in the dividend. But most of your gains are not going to be from your dividends. Most of your gains are going to be from your trades and capital appreciation. So you buy Apple 120 and it goes up to 150. The majority of your gains is going to be in that move from 120 to 150, not from the dividend. But generally, when you trade stocks, you buy stocks, you sell stocks, you collect a dividend. Those are the only ways you can make money trading stocks, really. In options, you have that, but you have more ways to make money. If Apple stock goes absolutely nowhere and it doesn't have a dividend, you make no money on your trade. With options, if the stock goes nowhere, you can make money. So you can make money if the stock goes up, you can make money if the stock goes down, and you can make money if the stock goes nowhere. That is unique to options. Super, super important. But then on top of it, you can make money via time. So think about it like this. If you buy Apple stock let's say you buy it at 150 and your target is 155. Whether it takes that move to go from 150 to 155 1 hour or 10 hours or 2 days, you still make the same amount of money. But with options, you can make money just from time passing. You can make money if your option trade gets to your price really fast. So that means over a short period of time, or you can make money if it takes a longer time for the stock to get to a particular price. That is unique to options, is this time aspect. You can also make money via volatility. You can't do that in stocks. You can use the volatility in terms of the way you trade stocks directionally, but you can't make money from the volatility. In other words, if Apple takes 3 days to move $5, you're still only making that $5 gain, whether it takes 3 days or 3 weeks or 3 months. But the faster it gets there with options, you can make more money. Or if it gets there slower, you can make money with that. In other words, if it has low volatility, you can make money by not just the direction, but the volatility component. And on the other side of that coin, you can make money if the volatility is really high and it gets there faster. So again, this is a unique way to make money with options that you can't make with stocks. There's also hedging. Options is probably the best way to hedge positions that you have. You have long stock. You can hedge some of the risk by selling calls, or you can hedge some of the risk by getting long puts. Those are two different ways to hedge your position, and they offer different aspects. Some cost more, some don't cost anything to hedge, but you can do real hedging activity with options that you can't do by, say, being long and short. It's a totally different way to make money. You can hedge trades in ways with options and various types of options that you can't do by being long and short stock. That's another way to make money in options. So you could be long Apple stock, and maybe you've been in it for a year now and you made some money, but maybe you think Apple's going to go down over the next month. Well, your long stock position, you don't want to get rid of that position. You like your position, but you're worried you might lose a little money on that long stock position. You can get long puts. If the market goes down, those long puts will make money. You make money on your options trade. Or you can sell calls. You can sell calls above the market. And if the market goes down, you get to keep the credit from those calls. That's selling premium. That's what they call selling premium, or collecting an income trading options. That's how you can generate an income trading options, is by selling premium. And there are many ways to sell premium. So this is a super important thing to understand. There's also a unique way to make money with options, which is a simple repricing of risk. And let me explain to you like this. So I lived in California for many years. As you all know, if you probably watched the news last year, California had a lot of fires. Now, think about it like this. If you bought your insurance on a low fire season where there was no fires or there was very low fire risk, and you bought fire insurance for your house, it was probably pretty cheap. But if you wait till the day after a bunch of fires start, that same insurance contract is going to be way more expensive. There's been a repricing of that insurance contract. And the same thing happens with options. You could be buying puts, after the market sold off for 2-3 days, but you're a little late to the game. The market's already repriced the risk and it's increased the price of those puts. But if you can see potential changes before they happen, you can buy the puts when they're cheap. And maybe the market goes down. It doesn't even go down to your price, but because the risk is increased, the price of those puts increase and you make money on that. So there's a repricing of options. And if you think about it, that's another way that you can make money in options that you can't via stocks. Super important that everybody understands that. Okay, so before we move on, actually, I'm going to hold that slide for a second. Let me just look at these questions here. Can I hedge short puts and calls on the same stock? Can I hedge short puts? Are you saying you want to know if you can sell puts and sell calls on the stock? Is that what you're asking, Abraham? Because that would be buying which one? Selling puts and buying calls? Okay, so buying calls and selling puts. If you're going to buy calls and sell puts, those are both bullish. You buy calls, you're expecting the market to go up. If you're selling puts, you're expecting the market to not go to the put strike that you're doing it. If you want to hedge properly, if you really want to hedge properly, you can get long the stock and then buy the puts. The long stock, if it makes money, if it goes up, but you also buy puts so that if it goes down, the puts increase in value. So that would be a proper way to hedge. But you wouldn't want to buy calls and sell puts, or that would be a double bullish bet. So yeah. Okay, let's see here. A couple questions on YouTube. Thomas, this question here, is it better to get into an option with high open interest? Yes, generally, because that means that there's more liquidity available. So if it has low open interest, that means there's not many option traders trading it. That means spreads will probably be higher. They'll be higher. You might have a harder time getting in and out of that transaction if there's not enough open interest to fill your contract. So yeah, you generally want to trade. My recommendation is, as a whole, avoid trading options with less than 100,000 total options. In other words, the total open interest is not less than 100,000. If it's less than 100,000 total open interest, I say avoid it. That's generally my minimum requirement. Okay, we got to answer Tom questions. What level of option trader do I need to be? Still not approved yet for option trading. So that's a broker thing. In terms of the requirements, it's hard for me to remember that because I never had to go through that. They just put me at the highest level. I think option or level 1 is you can trade calls and puts. Level 2, and somebody will have to check on this for me. And again, I'm not certain. Level 2 is you can trade like spreads, and level 3, you can start mixing and matching, get like full. I got to be honest. I don't know because I never had to go through that. They just give me the highest. When I first started, by the time I started options trading, they gave me the highest classification possible. So you probably want to look that up with your broker. Okay, Brian, I'm not sure what Brian's referring to there, but I'll have to go with that. Okay, last two questions here. Or last question here. Does selling calls require you to own the stock? No, it does not. But if you're going to sell calls without owning the stock, that means you have what are called selling naked calls. I don't recommend that for inexperienced traders at all because it leaves you exposed to upside risk, an unlimited amount of upside risk. Only for sophisticated traders would I ever recommend that. People that have a lot of capital and really know what they're doing. So yeah. What is the platform to trade options, and is there a minimum amount required? So that's going to be dependent upon what country you're in. But I recommend Thinkorswim. I love their option chain. It has a tremendous amount of features. It's easy to use. We're going to go over the option chain actually in a little bit. So yeah, it's a fantastic platform. Tastyworks has a solid one. Interactive Brokers is decent, but it'll depend upon what country you're in. You'll have to check, online based on what country you're in, what brokers offer options. But those are the ones I recommend the most. Ray Big Rock, please don't laugh, but I'm in a rookie trying to learn this business dealing with stocks, sir. But when talking about ways to make money, does this concept of up-down concept work for all stocks? For options, yes. In terms of stocks, if you want to buy a stock, if you think the stock is going to go up, you would buy that stock. If it goes up, you make money. If it goes down, you lose money. If you think a stock is going to go down, you'd want to sell that stock. If it goes down, you make money. If it goes up, you lose money. That's straightforward. Okay. All right, let's move on. There's a couple questions coming in. So let's move on to a few things, and then we'll get into some more details in a little bit. By the way, if you can, for those of you in Zoom, please post your questions in the chat. I don't look at the Q&A. So go ahead and move your questions over to the chat, and I'll get to them on the next Q&A. So Emmanuel and Anonymous Attendee, if you can move your questions over to the chat, I'll take a look at that. Okay, so we've talked about the various ways to make money, and one of these on here was volatility. So volatility, if you think about it, volatility really, in a very simple explanation, is the potential for a stock to move up or down and by how much. So for example, let's take a stock. Let's go like Tesla. Tesla is generally considered a highly volatile stock. it has the potential to move $50, $100 in a day. And it's priced at, around $1,000. I think today's closing price is a little over 1,100. So it could move tomorrow to 1,200 or to 1,000 pretty quickly. There are other $1,000 stocks that generally don't move that much in a day. And so the ability to move up or down, if it can move very far up or very far down, that's a high level of volatility. The volatility is the potential for this kind of variability in price, or the ability for price to move up or down. So that's volatility. There are other stocks that are low volatility, like Home Depot is a low volatility stock. It's generally not going to move $100 in a day. In fact, I don't think it's ever moved $100 in a day, but it may move $2, $3, $5, maybe $10. And that's a $300-$400 stock. And so that's a low volatility stock. It doesn't have a whole lot of potential to move that far up or down. Now, how much a stock moves up or down is going to have an impact upon options. And volatility is one of those things. If you think about it, let's go back to the insurance analogy. If you live in northern Canada where there's no trees, it's very cold, there's a lot of water, your fire risk is very low. So therefore, fire insurance is going to be very cheap. But if you live in the national forest in California, your fire insurance is going to be very high. There's a high probability that can happen. And so for options contracts, volatility matters. It matters in terms of how expensive or how cheap contracts are, because if there's a high volatility in a stock, then the price of those contracts tend to increase because they're more expensive. There's a greater chance for it to move around all over the place. But for stocks that have low volatility, those option contracts tend to be cheap. And so volatility, an increase in volatility generally increases the price of that stock. Now, with that being said, I'd like to share a trade that I took, one that I even pretty much gave you all a heads up on Twitter ahead of time that, hey, I see an opportunity here to trade volatility in this particular stock. So let's get into this. OPAD. On September 15th, OPAD had a pretty strong run on the day. It was up about 20, 30%. But on September 16th, the options volume exploded on OPAD. September 16th was a day before the Friday expiry on the 17th of September. And so it caught a lot of retail, the Wall Street bet interest. There was an 8 times or an 800% increase in the options volume. Prior to today, or this is what I wrote in the tweet on September 16th, you can see it right here. OPAD prior to today had 35,000 options in the entire universe. That was the total amount of options in the universe. After today, 250,000. That's about an 800% increase. So it's huge. That's a huge amount of options increase. That's an enormous amount. Very few stocks ever have a 700 or 800% increase in the total options volume in one day. Now, I did a little investigating. How many short dated, in other words, expiring tomorrow, because this was the 16th. And on the 17th, there was a lot of options that were expiring. Of the 214,000 options traded on the day, 129,000 options were short dated. They were expiring tomorrow. This is important to understand. And of the 129,000, about 100,000 were calls. So literally 10 out of every 12 options on the day on OPAD were calls, and they were all expiring the next day. IV, implied volatility, closed at 651%. That is absolutely insane. It's one of the highest IVs I had ever seen. IV at one point was over 700%. Now, let's go back to that volatility point I mentioned earlier. Do you remember how I said as volatility increases, it increases the price of the options? Put a 1 in the chat if you remember that. Put a 2 if you don't remember it. Very good. Okay. Cool. Very good. Okay. So if we think about this, what happened to OPAD, 700-800% increase in options, and a lot of them are expiring the next day. It created this huge increase in volatility. It also means that the options contracts blew up. in price. They just kept getting more and more expensive as the day went on. Now think about that. If the contracts, the options are getting more and more expensive, won't they eventually get to a price where most people won't be able to buy those contracts? Another way of explaining this is that I last year bought, roughly a $70,000 custom BMW. And when I showed at the dealer, I knew what the price was. I was happy to pay that. Totally fine. If I go on the dealer and they said, hey, small detail, this BMW is going to be $71,000 or $72,000, I wouldn't have balked at it. But if they had come to me and said, even though we quoted you $7,000 yesterday, today the price has jumped to $100,000. Are you still interested? I wouldn't be interested because the price will have increased to a point where it's no longer worth it. And that's what happens when implied volatility goes up. Eventually it gets to a certain level where the contracts are just too expensive. They require too much margin. People can't pay for them. And when that happens, that means it starts running out of fuel to keep that price elevated. And when that happens, and it is no longer able to get that new fuel, the new buyers coming in to pay these elevated prices for these calls, what's going to happen? It's going to go off. I literally said this on Friday or Monday. This will lead to a massive reversal. Now, let's take a look at what happened. And the question is this volatility sustainable? No. Here is just before, a couple hours before close, right when we were about to do our trade. 718%. It closed at 651%. So it already closed from one of the high points of the day. Means it was already coming down a little bit. That volatility pricing was coming down. And look what happened. Thursday, this is the big explosion in options volume. Wednesday, good day, up almost 30%, but very low volume. Thursday, huge explosion in stock volume, huge explosion in volatility. I tweeted this at 1:09 p.m., right when this candle was forming right here. I tweeted this because I had been watching this trade for hours. And I told my students, hey, you need to watch out for this. This is going to come down in volatility. This is not sustainable. And so what happened? The volatility came down in the aftermarket, sold off the next day even more. It was a perfect trade opportunity. It was a way to trade volatility. And if you wanted to, you could have traded direction and volatility and made money two different ways, which is what I did. I sold a ratio spread. So I made money on direction and I made money on volatility coming down. By the next day, it was down to like 300%. And that shrunk the price of those options tremendously. So this is a way to make money on the direction. Yes, you can do that. Or you can just trade the volatility alone. You can look for these mispricing opportunities where volatility is too high or volatility is too low and trade volatility. This is a unique way to make money that you can't do with buying and selling stocks. So any questions on that before we move on? Dory Lama says, I like your talk on the back wall. Thank you. I appreciate it. Got a couple back there. So Sri Yantra, Vajrasafa. Julius Taberry says, this is dope. I appreciate it. Okay. LOOL says, so if implied volatility is high, you sell, and when it is low, you buy. That's a general approach, but that's not always totally accurate. Implied volatility is high, but it could go higher. You have to learn how to read when implied volatility can go higher, or is it no longer sustainable? I was watching this for several hours through the day, watching how it was playing out, and my experience pretty much told me this is not sustainable. Just because IV is high doesn't mean you necessarily want to sell, because IV could be high and go higher. You have to understand under what environments is there a greater potential for the IV to be more volatile, and when is it more likely to be less volatile? That has to do with dealer market maker, what we call gamma. We'll talk about that in a little bit. But if it's unsustainably high, yes. Sadly, I saw a lot of people who were a little late to the party the next day, and they were buying OPAD on open. You could see all the tweets, buying OPAD on open. You could see it on your public account, buying OPAD, buying OPAD. They didn't understand options. They got crushed. OPAD's never been back. Never been back. As far as I can tell, it hasn't been back. I haven't checked in with them, but they missed the opportunity. They didn't understand what was going on. They were just kind of reacting, not really understanding the market. So yeah. But as a general rule, LOL, that's generally correct. But there's a little more nuance to that, which will take a little more time to tease out, and that would be a different subject. So we'll get into that a little bit later. But as a general rule, that's generally a good rule. The key is to knowing the timing. Julius DeBerry saying you got puts. I did not buy puts. Puts are expensive. Puts were expensive because of high implied volatility. So I took advantage of volatility while taking advantage of direction. How do you rate IV and what's high in your opinion versus low? Check the history of the IV on the stock. That's definitely the best way to do it. So it's important to understand that you can't look at implied volatility as the same across the board. Normal at the money implied volatility for the front expiry on SPYs is around 10 or 12%. That's not very high. Normal at the money volatility in, say, Robinhood stock is like, I think it's right now at 80%. So you can't have like, okay, X percent, between 10 and 25 is low and this and this. It's going to be relative to that particular stock, certain, or that particular instrument. SPY rarely ever gets above a 30 implied volatility, whereas Tesla almost never gets below a 30 implied volatility. So, or at least for the at the monies. So it's important to understand that we have to look at each particular stock, see what their general average is, and then kind of look at it historically and see, is it elevated or not? Thinkorswim has a really good indicator set that you can put up implied volatility, and then you can put up historical volatility to see if there's a displacement between the two. So yeah, it's a great question. Kongxi, ratio call or put 2-to-1, 3-to-1. I'm not sure what the question is there. If you're asking, yeah, can you give me more specifics on your question there? Because that can mean a lot of things. Julius DeBerry, so how do you make money on the IV if you didn't buy puts? I sold a ratio spread, which is a little more advanced option strategy. We will explain that in the Benzinga option school, but it's a ratio spread. So you don't have to buy puts to make money from it going down. You can sell a call ratio spread and just keep the credit. You can sell a put ratio spread and make money as long as it stays within that. The ratio spread is not the focus of today's lesson or class. It's a pretty advanced strategy. I don't recommend traders use it until they've had probably 500 option trades under their belt and they're profitable trading options, and they really understand Greeks, and they understand, the strategies and everything like that, and they understand dealer hedging. Like that's for advanced users. So we will teach that as an advanced strategy in the Benzinga option school, but it's not the focus of this lesson. Yeah. So I'm sorry for being cryptic about it, but that's about as much as I could say. Okay, let me get to my Zoom questions here. And again, for those of you in the Q&A, make sure you move it over to the chat section here. Okay, Emmanuel has a question. So did you buy a put when the price hit the top? No, I didn't. I sold a ratio spread. So ratio spread, I'll just give you a brief description of it, and then I need to move on because I need to cover some more things here. A ratio spread is simply, if you're doing a call ratio spread, you'll buy a call at one price, and then you'll sell. So let's say you buy one call, and then you would sell two calls at a higher price. And so that creates an imbalance, but you're using the extra calls to fund the long call here. Problem is ratio spreads have open-ended risk, so you need to be able to control that risk, and it requires a lot of margin. I generally don't recommend it to anybody with less than a $50,000 account because margins on ratio spread are huge. On the low end for a cheap stock, they could be 10 grand. On the high end, you could be putting 100, 200 grand just in margin to trade one of these. But they give you a range of profitability, and they give you various levels of profitability. And so, yeah, that's a call ratio spread. And a put ratio spread is just the opposite. You're going to buy one put. You're going to sell two puts at a lower strike. Now, the ratio is the 1-to-2. That's why they call it a ratio spread. This could be 10 calls, which would make this 20 put. This could be 10 puts, which could make this 20. It's always a 1-to-2 or 2-to-4 or whatever the ratio is, but you maintain that ratio. So yeah. How do you go long or short? Sarah has this question. How do you go long or short volatility? If you want to go long volatility, then you want to wait till volatility is low. Generally, the best way to go long volatility is to get long options. Then if you buy options, you're long volatility, you're also long gamma. If you want to short volatility, then you'd want to sell options. That means you're selling the volatility, you're selling gamma. That's a short way of describing it, but there's more nuance to that. How did you find out about OPAD for you to trade it? Benzinga Pro. I use the Benzinga Pro app. I love it. It told me, hey, this is one of the big movers on the day. Had a lot of volume on it. I looked at the options data. I saw it as a big mover, and then I was like, this is kind of odd. There was no news or anything like that. There was no catalyst. There was no earnings or anything like that. Then, reports started to come out. It's getting a lot of interest from Wall Street Bets. A lot of people piling into that. I started looking at the options data, and I was like, yeah, I know it's going to happen here. I've seen this before. And I just waited and timed it and waited and timed it, and then boom. So yeah.
Hey, Chris, really quick, for all those that are asking about the Benzinga Option School, just want to let you guys know the Benzinga Option School comes with Benzinga Pro. So as you get the Option School, you will have access to everything that is inside Benzinga Pro, meaning that you can do research analysis there, all the tools that you have there, bring them back to the school, chop it up with Chris to see, his thoughts, and with the community, because you're going to have a chat room just for you guys, the student trade ideas, where Chris will be able to pitch in. You're also going to have a separate chat room, and that separate chat room is basically where only Chris will be able to post, and you're going to see all the trade ideas. So live lessons, live Q&A, open discussions, market examples, lessons, and more importantly, the full community. So all of that is with the options trading school. So I'll just put my info really quick so we can focus on the education, but just wanted to get those questions out of the way, Chris.
I'm glad you mentioned that too, because, somebody was asking, like, how did you find it? Most likely you who are listening would not find this, or you wouldn't necessarily think about it per se. You might think, hey, let's get long calls if I think it's going to go up, or let's get long puts if it's going to go down, but that's not always the best way to do it, because you might be overpaying for those calls or puts. And so that's where somebody with 21 years experience, that's when someone with institutional experience, somebody who's a broker, somebody who's a hedge fund trader, somebody who's spent thousands of hours learning and trading about options, that's where I come in. And so with the Benzinga Option School, we are going to have we have a morning class. Then we have an entire class, which is market examples, where we're showing everything we've learned in the course for that day and say, hey, here's some examples from today. This is how it applies, and this is how you want to trade it. When trade alerts or things like this come out, I'm going to be like, hey, traders, look at OPAD, high volatility, not sustainable. Here's potential option plays. You can do this option, this option, this option, this option. And so that's the benefit of the Benzinga Option School. It's not just training. It's not just education. It's not just feedback from me 5 days a week, but it's also access to potential trade ideas and what I'm seeing in the market. And you're going to see as we go further in this presentation how valuable that is to be able to know, like, hey, I'm probably seeing things that you're not seeing in the market. And that's who I'm going to be sharing it with, is the members of the Benzinga Option School. So I hope you get to join that. Okay, let me answer a few more questions on Zoom, and then I'll get to the lads and lasses at YouTube. Wandu has a question. What material you recommend to read to know more about options? So in terms of reading, I have a bunch of free material on my website, secondskiesforex.com. I'll put that in the chat right now. We have a ton of free material to start, get your basics out of it. But we will also be giving, a ton of material in the course as well on how to learn the basics about options. Okay, so that's that question. Would I end up putting the limit order before the market close? That depends. You don't necessarily have to put a limit order. I placed the order. I placed a pure market order because I knew exactly what option I wanted to trade, what structure I wanted to trade, how I wanted to trade it. So I placed it before the market closed. So yeah, you don't have to. If you, the thing about it is that, and this is kind of the part that you miss out, is if you did put a limit order after the market closed, this blue is the aftermarket. So all these blue vertical lines, that's the aftermarket. The white is the regular market. So if you had placed a limit order here, your order wouldn't have been potentially activated, but the price has already moved $2. And by then, the option prices will have changed. You might not get it. That's the difference between understanding timing. Under certain conditions, I would tell my students, yeah, place a limit order. But under conditions like this, I felt it was right for a market order. So that's how I did it. Brad Barnett is saying, who sets the prices? How are they set? So it's important to understand there's a lot of mathematical equations like Black-Scholes models in terms of option pricing, but you really have three essential players in the options market. You have the players, which is the traders. That's me and you. You have the referee, which is the options clearing corp. And then they kind of set the rules of the road. And then you have the brokers. And so the brokers are really kind of the playing field. They're matching up buying and sellers, offering spreads and things like that. That's really how it works. So it's really, those are the three players that are involved in it. In terms of the pricing, there's mathematical models on why they do it. It doesn't really matter. The key is that you understand what affects those pricing. How does volatility increase or decreasing affect those option prices? How does time affect those option prices? How does the market moving up in a low volatility environment versus a high volatility environment, how does that affect pricing? That's the more important question. How do you know when volatility is high? You can look at historical versus implied. That's a simple way to do it. If you have a lot of experience with that stock, then you'll just know, hey, we're in high volatility because IV is above average. So there's no fixed percentage that will tell you IV is high because it's relative to each stock. So you have to look at historical versus implied. Does this work for penny stocks also? Yes, but generally with penny stocks, you generally don't have as many options. And therefore, if they do have options at all, and if they do, options tend to be illiquid, high spreads, hard to get in and out of them. I generally don't recommend them. Does IV play a role when buying leaps? IV plays a role in every option. If every option you buy or sell, IV plays a role, and you have to understand specifically how IV affects that role. Vernon has a question that doesn't work with just calls and puts. It can, if you're talking about this one here, but if they're overpriced, then you're overpaying for those calls or puts. And so that's where you have to understand Greeks and pricing. It's something we cover in the Benzinga Option School very thoroughly. So yeah, you can't just look at, oh, if the market's going up, I buy calls, and oh, if the market's going down, I buy puts. You have to understand that the pricing of those options matter. And the Greeks is what really affect. The Greeks are the dynamic variables that affect the pricing. So it's important that you understand that. Otherwise, you'll be using the wrong options at the wrong time. Is selling puts the same as buying calls? Yes and no. Yes and no. Not entirely, though. They're both directionally the same bet, but selling puts, if you're selling puts, you have a higher margin requirement. You have higher exposure. If the market keeps going down, you have exposure all the way to the stock going down to zero. Whereas if you buy calls, you're paying a fixed premium for their calls. That's your max risk. So directionally, they're the same, but they're not entirely the same in terms of the option structure. Chris, I heard you say Hood. Is this a good platform for rookies other than E-Trade? I'm not a fan of Robinhood, especially since they have a payment for order flow type. Like that's their primary source of income. And since that's their primary source of income, that means they're highly incentivized to prioritize that over everything else. Like their largest portion of income comes from PFOF, payment for order flow. So I recommend, if you're a beginner, either starting with Tastyworks or Thinkorswim. So I think those are two of the simplest to work with. and they all have tons of videos on how to use them. It took me like a week and a half to fully understand thinkorswim options. And that's 95% of everything I do today. It took me a week and a half. So that's my recommendation. A few more questions on Zoom, then I'll get to my YouTube peeps. For 1K account, not a good idea to try ratio spreads. No, you won't have the margin for it. What types of stocks are better to trade options on? The $20 ones, 50. There's no fixed answer for that. There could be plenty of $20 stocks that are great to buy options on, and there can be plenty of $20 stocks that are horrible to buy options on. You have to understand how options work, how options are priced, why they're priced that way, and how the Greeks affect their pricing. And when you throw all that together, it basically means that there's not a particular price of the stock that is good or bad. Each stock has its own individual variables. And so certain stocks will, display low volatility characteristics. Others will display high volatility characteristics. So it just really depends on what options you like to trade, how you like to trade them. Do you like to trade volatility? Are you more of a directional trader? Do you want to hedge? How do you want to day trade? Do you want to swing trade? All of those variables matter, but you can't look at it as hey, is it 20? Is it 50? Is it $100? As long as the stock has good liquidity on the options, then it's potentially a good stock. But then there's a question of, is it the right time? Is it the right opportunity? That's the benefit of the Benzinga option school, is because we're going to be talking about, hey, this is the right time and the right opportunity to be trading that stock, or this is the wrong time to be trading that stock, regardless of the price. So yeah. So we said earlier, open interest should be 100K or 10K. I generally do not recommend trading options with less than 100,000 open interest. Yeah, super important. That is great, beautiful execution. Thank you, I appreciate it. Okay, let me get to my YouTube people real quick. Benjamin Israel has a question. The candle at the top with the long rejection wick, is that your signal? Inverted hammer and pin bar? No, I don't trade single candlestick patterns. No, the candlestick had nothing to do with my signal. My signal was implied volatility getting to an unsustainable point. I watched implied volatility over the day, over the course. Actually, I really didn't start watching implied volatility until the last 2-3 hours. And then I would just kind of keep an eye on it, and I'd look at it and just see what was going on with it, going on. Oh, it keep going up. Okay, well, wait. And I was watching implied volatility to kind of stall itself out. And then when I felt like it was stalling itself out, that's when I jumped in. So my signals, regardless of the price action or options or whatever, I never look at one candle as a signal. Candlestick patterns are very inefficient. They don't teach you how to understand price action. I teach price action order flow, not candlestick patterns. They're very different. But it's a legitimate question. Even though those puts were expensive, seems like you could have made a killing with puts too. Yeah, but you would have overpaid for them. So yeah, I can make money buying a $3 million house that's overpriced that should be worth 2.5 million. And maybe I can flip it for 3.1 million, but that's going to be different than taking advantage of something that's overpriced and selling it at a high point. Like if I sell, for example, like if there's a house, let's say I own a house and the house is overpriced and I know we're in a housing bubble and I sell it close to the top, that's a far better profit deal than buying something that's overexpensive and selling it for just a little bit more. So yeah, you would have made some decent money on the puts. You would have made money directionally, but you would have lost money in terms of implied volatility coming down. So you would have had two forces fighting each other. You're making money directionally, but then you're losing money because implied volatility is going down. I don't want to make money one way and lose money another way in a single trade. I want all my variables moving in my favor, because then I increase the profitability. That's the way to make a killing. So the people who bought puts here, they actually didn't do that good, because unless they bought it here, but here's the thing about it. If you're long puts, you're long volatility, but what else are you long? There's another variable you're long. Put your answer in the chat if you know. It's a tricky question. Not a tricky question, but you should know. Yes. Sarah and Rogers, theta. You're also long time. And because this is a Friday, I have the most theta decay on this day. So I'm getting long puts. I don't know what the market's going to be like if I buy puts here. I have no idea what the market's going to be like that day. That basically means that I'm long gamma, I'm long volatility, but I'm also exposed to time. And the greatest amount of theta decay is always in the last day of the option. So I would have been exposing myself to a massive amount of theta decay, massive amount. And on top of it, if I got long puts before the close, I would have eaten theta decay just for holding it overnight. So let's say I buy these puts at $10 premium. I wake up tomorrow, I've already lost $2-3 in premium just for holding it overnight. I haven't made a single dollar in this option yet. In fact, I opened the market and I've lost money. So I lose money on theta the moment it opens. Maybe I've made a couple bucks on the decline, but then I've lost it in theta. So again, that doesn't make sense. It's not the best way to do it. Anytime you get long options, you're also long time. You're long theta. You're exposed to theta decay. So hopefully that makes sense. Yes, long gamma as well. John Abiu's got it correct. Okay. Kongqi, what is the advantage of shorting ratio spread? Instead of just shorting a simple call vertical. So again, ratio spread is not the focus of today's course or today's class. Ratio spreads are an advanced strategy. You would need a certain level of skills for me to even explain the value of this, why you'd use it, how it works, what's the best way to do it. So there's, in my opinion, Kongqi, you're jumping ahead of yourself. If you didn't know what a ratio spread was before today, you don't have the experience yet to really understand it today, right now. So my suggestion is don't worry about ratio spread right now. It's an advanced strategy. You're probably not there yet. If you didn't know what it is today, you're not there yet. And so that's not a put down on you. It's just a very honest, straightforward conversation we're having here. If I was in your position, I would tell me, hey, Chris, if you didn't know what a ratio spread was today, you shouldn't be worrying about it too much. It's an advanced strategy, has a lot of complexities. I need to spend 2 hours just to dive into that strategy alone. And that's not the focus of today's course. So my apologies, Kongqi. I'd love to answer your question, but I can't. Chelly, good to see you. Monday, Chris, with a new time slot. Good to see you, Chelly. Do you use RSI as well as IB? No, I don't use any overbought, oversold indicators. I find them really efficient. I find them really inefficient and lagging. I use price action. I use order flow and options. I use dealer flows. I, understand the Greeks. I don't use any indicators. So you can see there's no indicators on my chart. This is what my chart looks like normally. This is VWAP. That's it. That's volume. That's it. If you learn to read price action, order flow, you don't need those indicators. Under which scenario would you buy a straddle? Well, that's pretty straightforward. So if you're long a straddle, you're expecting volatility to increase. You're expecting volatility to go beyond, like, let's say I buy a straddle for $5 and at the 150 strike. Well, that means I need it to move beyond 155 to the top side or 155 to the bottom side. So you'd be buying it in a low volatility environment where you are anticipating that low volatility is going to become high volatility. There's more nuance in that, but that's the general explanation. GameStop was the original unicorn where every option written was in the money for like 4 straight days. I've been buying calls hoping for that same magic sense. Yeah, I'm sorry. Yeah, that's you've been buying calls for a year. You're living a pipe dream. You've been waiting a whole year for a girlfriend that's not coming. There's better ways to spend your money. There's plenty other trading opportunities out there than GameStop. The institutions have mostly moved on from GameStop. I would move on yourself. They don't care about it in the same way that they used to. Okay. I think I've gotten all the YouTube. I'm out of battery. Oops. Plug that in on the next Monday to buy and then sell by that Wednesday. Sorry for not being clear the first time. I missed your question, Ray, on that, so I'll have to go back and see if I catch it. Oh, wait, there you are. Okay. Chris, is selling puts really good to buy on Mondays from stocks that were up on Friday that is down? That there's no fixed answer to that. There's so many other variables in that. There's where's the open interest? What kind of dealer flows are there? Delta hedging, gamma hedging? Is there potential news? It's important to understand that when you think about trading, yeah, you do need to simplify it a little, but you can't simplify it that much. Like you can't think like, hey, the stock is down on Friday or it's up on Friday. You know, let's see, you want to sell puts on, is selling puts really good to buy on Mondays from stocks that were up on Friday that is down? Then buy on Monday and possibly sell on Wednesday. Yeah, you can't look at it like that. That's too, there's so many other variables that go into that again, is implied volatility. You know, what's going on with the open interest, what's going on with the option dealer flows. There's no simplistic strategy like that really works out. You definitely want to simplify things, but you don't want to simplify it that much. Glenn, sorry, I have to check Benzinga to learn this. I'm not learning first option stream for me. Okay, good. Well, this is your first one. You've gotten a lot of this. We've covered a lot of information. Some of it, you know, is definitely beyond introductory level. And so don't be frustrated with it. Just be patient, take in what you can. And then, you know, I have a ton of free articles on option trading, intro to options on my website that will get you started. So hopefully I answer your question. Amy Masuda, please post your Q&A in the chat. I'm only looking at chat. Okay, I think I've covered everything. All right, cool. Let's move on to the next. Really, we skipped most of the basic concepts. We covered some of it, but you know, I don't want to spend 2 hours teaching the very basic of options, which is something that you can get for free on YouTube or free on my website. There's no point in that. I want to talk to you about little more intricate stuff that you're not going to find on YouTube, that you're not going to find on most websites. And so, yeah. What is my website? I put it in the chat, secondskiesforex.com. Okay. All right. So we had talked about how option dealers and market makers have an outsized impact upon the market, even more so now than ever. And I do want to post, though, I do kind of want to bring up this one picture that's not in the slide real quick, but it's really helpful to kind of see this. So let me put up this picture for you here. So this is done in September. And what this shows is, you can see right here, single stock option volumes remain elevated, even as share volumes have declined to year-to-date lows. So this was done in September. So what this means is, here's single stock shares. That means single stock shares is like not SPYs, which is an ETF, but like Apple or Twitter or Microsoft, single stock shares. People are trading less shares these days. What this blue line is single stock options, and you can see the volume going up and up. That means that options are having more of an impact upon price than shares. Their impact is continually increasing while share volume is decreasing. So it's important to understand. That basically means that if you don't understand options, you're not understanding what the biggest 800-pound gorilla in the room is doing. You're just trading blind. You're like a kite in the wind. You're like in a room with a bunch of animals and you don't even know that there's an 800-pound gorilla behind you. It's a bad situation to be in. As you can see also right here, single stock options market is now 140%, 1.4 times the underlying shares market based on daily value traded. This is in September. The number's gone up since then. So you can see there's options being traded at a value of 1.4 times the shares. Basically, you know, that basically means that for a particular stock, if the stock traded 100,000 options on the day, the total amount of shares traded by the options was about 140,000. So again, options is having a bigger impact than the shares. All the more reason why you want to learn options trading now, because this is the biggest elephant in the room. It's the biggest 800-pound gorilla in the room is options. Super important. Okay. With that being said, So I've talked about how option dealers and market makers are the most active option players out there. They're constantly hedging. If I buy calls, they sell calls, they got to hedge that. As the price goes up or down, they got to hedge that. As the volatility increases or decreases, they got to hedge that. It's important that you understand that. Now, I've talked about dealer gamma, and this is kind of important. And so it's important that you understand these concepts. Positive gamma is a market environment where the market is net long options. And this is important to understand, in which we're going to make very clear in a second. Negative gamma is when the market is net short options. So the overall market is net short options. Now, this point right here, dealer gamma increases or decreases volatility. This is displayed via data. So this x-axis is dealer gamma exposure right here. And then this is volatility. This is how volatile the stock is. This is the 0.0%, like what's the kind of standard deviation moving, or what, what's the rate, the percentage that it moves up or down. And so if you think about it like that, from this point on is the volatility when the market is positive gamma. What do you see? It's very compressed in a narrow range. Very rarely do you have high volatility days when the market is in a positive gamma environment. This is important to understand. When the market is in negative gamma, which is this environment here, you can see the volatility is much greater. It's a much wider range of prices up and down. Now, if you think about this, and we've talked about what volatility and how volatility matters, that basically means that when you're in a negative gamma environment, you should be expecting more volatility in that stock or in the market. When you're in a positive gamma environment, you should be expecting less volatility. So if you think about that, that should have a serious impact upon how you trade for that particular day, especially if you're day trading SPY options, which I do a lot. I day trade SPY options just based upon the overall market gamma. High volatility, I'm expecting a wider range. Low volatility, I'm expecting a lower range. Super important that you understand that. So put a 1 in the chat if you understand what that means, like what I mean in terms of positive gamma and negative gamma. Put a 2 in the chat if you do not. 2s, 1.5s. Nice answer. I like that, Sarah. Very clever. 2s, 1s, 2s, kind of a mix. Okay. Somebody had the question, positive gamma means what again? Positive gamma means the market is net long options. This comes back to the Greeks. Gamma is one of the Greeks. Gamma is the rate of change of delta based upon the movement of the stock price. Now, there's positive gamma and there's negative gamma. If you buy options, you're long gamma, and that has a range of implications. If you sell options, you are short gamma. You have negative gamma position, and that has a range of implications for and against your position. So if the market is net long options, then the market is in a positive gamma environment. If the market is net short options, the market is in a negative gamma environment. So hopefully I answered your question. Yeah, okay, there we go. Seems like you got it. I could use more explanation. I'm ignorant of option Greeks. Option Greeks is a class in and of itself, maybe even many classes. It's not the focus of today. It's just kind of to give you a brief kind of hint and understanding about it. This is a brief explanation of what we teach in the Benzinga Option School. Market Greeks is not something you want to learn right off the bat. You need a little bit of experience. You need to learn things in order. But to simply explain it, there are various market Greeks: delta, gamma, theta, Vanna, charm, vega, all these different things. And they all affect the pricing of options. And they all are based upon moneyness, time, volatility, direction. It all matters. But we're not here to this class isn't about the market Greeks. So that would be a several hour class.
Let's go ahead and show them the syllabus if you want, Chris. We can share it and
Yes.
show them the
Please.
schedule, because I know
Please.
there's a lot of work here that's been put in. Let me go ahead and share this really quick. 1 second. Okay, do you see that? You see the syllabus, Chris?
Yes, I see it now. Yes.
Okay. All right. So these are all the chapters. Maybe if you want to go through them, Chris, I know you can definitely explain this better on your end.
Yeah. Okay. So with that being said, we have layered the Benzinga Option School in a particular order of classes that through my 21 years experience in the markets, through my 17 years teaching people at the brokerage, at the hedge fund, and teaching students privately, that I've kind of learned that you need to kind of start with the most basic concepts and then slowly work your way up. If you skip steps, you learn things improperly. If you go for advanced concepts too early, you make mistakes, you lose money. And so we built the Benzinga Option School so that you learn things from the ground up. And so as you can see in chapter 1, that's the introduction to options. We teach all the most important concepts that you need to understand about options. So you understand how the options market works, functionality, the key terms, how it really functions as a market. The second class 2, is understanding option Greeks. And so after we've given you this nice solid foundation, then we spend an entire class hours teaching the option Greeks. And we go through each one individually. We share examples. We go through the option chain, how to understand it, and what are the various implications of each Greek, because each Greek, delta, gamma, theta, vega, vana, charm, these all have an impact upon the markets. They all have an impact upon pricing. They all have an impact upon dealer hedging requirements. They all have an impact upon flows. It all matters. And you have to understand how each one works individually and then synthesize that collectively. And so you can see why that's a big class. It's not something we can just cover in a few minutes. So we cover that in class 2. Then in class 3, we really dive into volatility, which is a very important subject. I've talked just briefly about it today. Like 5% of what's in the Benzinga Option School, that's what I've talked about today. Volatility is its own important concept that you have to understand because it has a massive implication in terms of pricing of options and the Greeks and how options work, whether they're good or bad options, whether they're overpriced or underpriced, whether there's trading opportunities or not. You have to understand volatility to understand options. Then classes 4, 5, and 6 are going through the various strategies. We cover them in terms of like a mechanical basis. Here's the strategy. It's these calls, it's these puts. We show you what the P&L structure looks like for each of those. And then we make sure that you understand what is the right environment to use that in, which is class 7, how to match the right option strategies with the right environment. You can learn the option strategy and learn how it functions, but if you don't know the right price action structure or environment to use it in, you're not going to be able to use it that well. You'll be using the wrong tool at the wrong time. And then the 8th class is the most advanced lesson. That's on market gamma or dealer gamma. And it's really talking about how do dealers hedge initial positions, and then how do those hedging requirements change over time? How does that impact the markets? How does that create support and resistance? How does that increase or decrease volatility? How do you trade that? And the very end of that lesson is various strategies or various ways to build your own option strategy. So somebody had a question in here. I think it was Amy Masuda said, hey, do you teach options in a swing trading way rather than day trading or short-term trading? And then they said, because volatility is a short-term thing. So volatility is not a short-term thing. It's important over all aspects of your expiries, but we teach day trading. We teach swing trading. We teach, this kind of medium term, monthly expiries, quarterly expiries. We even teach you how to do leaps. We teach every type of, possible strategy out there that you would want to use, whether it's short day trading or that's, you want to do weekly expiries or monthly expiries or quarterlies or yearlies. We teach you various strategies and then how you can build your own. And so that is the the curriculum of the Benzinga Option School. And we have an entire lesson that is hours long of just what I'm spending 5-10 minutes here talking to you about right now in dealer gamma.
And this doesn't even cover office hours or all the other bonuses and perks here that you got planned there, special lessons, special market situations. That's not even in there.
Yeah. So we have a course every Monday through Thursday. We have a course lesson and we cover a different lesson each day. We do lessons 1 through 4 one week, lessons 5 through 8 the next week. And then we start back at 1 through 4 the following week. So week 3, we go back to lessons 1 through 4 again. But each day we have a lesson. We have a couple hours just towards the course lesson. Then we have another session later in the day, a few hours later, that is market examples of everything that we talked about in that lesson. And then we have office hours on top of that on Fridays. And we have the chat room, which is all about, hey, here's potential trade ideas. Here's what I'm looking at. Oh, you have this trade idea. This is what I think of that trade idea. So, it's just such a rich interactive environment that it's not just me teaching lessons and then you got to figure it out on your own. No, we're going over examples every single day, sharing all kinds of trade ideas, not just me, but the other students are sharing trade ideas. And then I'm reviewing that and giving my analysis and say, hey, this is a great trade. Here's how I would do it with options. This is this is that. Or no, I wouldn't take this trade, but I would do this trade. So that kind of, feedback and education is just, I wish I had had that 21 years ago when I started, because when I started, there were only 6 websites on the planet about trading. Now there's, millions. So this level of education is just, I wish I could have had this from day one.
Yeah. And, from my experience, Chris, when I started trading options in general, there wasn't much like this. So, the typical pump and dump chat rooms, fake accounts, bot profiles. I went through all that stuff, man. It took me a while to figure it out because, that's just how some people are mentally, oriented of what they want to do. But this is something very different. We have a very great community here of zingers, great community of people that want to help each other, want to succeed. And, we all do that together to help each other as retail traders. So it definitely has a different vibe. I can tell you that. And I'm pointing here the schedule if you do want to, pinpoint to that in a bit.
And is your cat part of the trading community as well?
It might be we did it one time but no.
Oh, that's awesome. I have cats too. So I love having them around. So, okay. All right. So with that being said, I appreciate you showing the curriculum and, what you said was super important because if you spend a few months or a couple of years learning options improperly, well, the challenge there is that you have 2 things that you have to now do to actually get on track. You have to unlearn the things that you learned improperly. That's going to take time to wire into your brain. And then you, from there, have to replace those bad habits that you've unlearned with good habits. And that takes time to learn. And so to be able to learn the right way from the ground up matters. It saves you time. It saves you money. It saves you a process that you don't have to go through of unlearning and then relearning. And if you've already learned things improperly about options, don't worry, we're going to correct that as fast as possible. So I am actually using, I studied neuroscience as my undergrad. I'm going for my PhD in neurobiology. My specialty was human learning and memory in my undergrad program. That means I basically spent years studying what's the best way to use the brain to learn things in an optimal way. And so we've not just built the course on a foundation that I think is the best way to learn options, but I'm teaching it in a way using these neuroscientific principles to help you use your brain in the most optimal way to learn these things. So it's just a unique thing that I don't think is really out there right now.
Absolutely. There's a lot of things. I think psychology is very important. A huge part of the market doesn't get talked about too much for different reasons, but yeah, I mean, Chris, when I started trading options, it was just, there's a lot of these stock gurus, a lot of these kids and TikTok and, people that you can tell they just want a like or something like that. They don't really have that professional background, that professional experience. And I guess people, because they're in social media, maybe they get peer pressured into these things, not really knowing what they're getting into. And people that I talk to that have joined the option school, they tell me about these stories of different things they've tried. And I get it, but it's just great that we've been able to come up with this, Chris, because it does mean a lot. The feedback I'm getting from the people that have joined, just from the lessons we've done so far, just before we start on January 10th, the official start date, it's already made a difference in a couple of people understanding options from the macro, right? Not just from the micro side, but the actual industry of options. I think that's a huge lesson that doesn't get talked about.
Yeah, it's super important. I don't hear many people talking about it. And, you know, the key is to be able to synthesize the information as well and present it in a simplified manner to everybody. And that's very important, because otherwise it doesn't matter if you're like the best option trader in the world. If you can't teach it or you can't explain it in a simple way, then people are going to have a hard time getting it, and their process is longer. So, I'm not a TikToker. I've been trading probably for more years than most TikTokers have been actually alive. And I have real institutional market experience as a former broker, as a hedge fund trader, that, and probably 95% or 98% of the YouTubers and TikTokers out there do not have. So you choose who you want to learn from. I hope that is me. But there's a few more slides here, Rodrigo. Do you mind if I go through this and then answer a few more questions?
Yeah. Slides, and go ahead. And I just wanted to show them the schedule, because I know we're getting a lot of questions on that. It's a typical question. So I just wanted to get that out of the way, Chris. That's it.
Please.
Yeah,
okay,
go ahead.
So with that being said, Steve had the question, are the classes scheduled or view on demand? So they're scheduled, and we have the schedule here right on the screen. So the 10 a.m. is that should be, that is Eastern time. Okay, so it's at 10 a.m. Eastern. That's the first lesson lecture, and that's for about 45 minutes to an hour. Then we have about another hour, an hour and 15 minutes for Q&A and current market examples of everything that we learned in that particular lesson. Then a few hours later, about 3 hours later, we do not only a lesson review, but open market discussion. And the open market discussion is really like, look, these are the option trades I'm looking at. What are you guys looking at? Let me analyze your trades. Here are some of my trades. Here's what I'm seeing in the market. If I see an OPAD trade or something like that, this is what I'm going to be talking about it. And that's right before it's the last hour of the market close, so that if you want to make some trades before the market close or set up for the next day, you can do that. And that's Monday through Thursday. So it's the same schedule Monday through Thursday. Then on Friday, we have, it's like office hours, open Q&A. It's basically open Q&A for any of the topics that we covered in the prior week, or any trade ideas that people want to look at, or any trade ideas that I have and I want to share. So every single day, we're going to be talking about and sharing different trade ideas, different option setups, different things that I think are good or bad for options, and also analyzing your setups as well. So it's just an incredibly rich opportunity to really get not just a lot of education, but a lot of feedback. When I started, I didn't have anybody to get feedback on. I couldn't ping anybody like every single day and be like, hey, this is the trade I'm looking at. What do you think? This is how I structured it. This is what I'm thinking. This is what I do. I had none of that. It was only, 4 years later, until I became a broker, did I get that feedback. Had I had that feedback from day one, I would be a much wealthier trader than I am today. So I can't tell you how important it is to understand that your learning process, the faster it is, the faster you get to making money, and the learning process matters.
Hey, Chris, just want to give a quick shout out to Brian and Timothy, who just signed up here for the Benzinga Option School. Welcome, guys. Welcome.
Welcome aboard. I am looking forward to working with you. So I'm very excited about that. Okay. Let's
take over the screen.
Yeah, let me do that. And then, and let's get into a few things here. So let's get some Q&A on the Zoom chat, and then we'll get into YouTube. And then I'd like to go over the last few lessons for the day here. So Diane Thomas says, this was advertised as an intro to option trading principles. It appears there are several of us who were looking for the basics, which we're not getting. So this wasn't an intro to options, intro or basic options. This is not what this was meant to be. Intro to option trading principles. And so I am covering some of these introductory principles. I covered the 5 core principles, and then I've gone through a few of them throughout this thing here. I understand, hey, you were probably looking for the basics and you probably thought this was going to be the basics. But the thing about it is that if I was to do a 2-hour webinar on all the basics of options, the thing about it is that is already free on my website, and it's already free on YouTube. So why do something that's already there that you can get for free? Why not teach you something that you can't get for free? even though we are offering it for free. I'd rather teach you something unique. So this is option trading principles, not intro to options or basics about how the options market works, so to say. So I apologize if there's any confusion. I do hope you were able to get something out of this. And if you want a ton of free material about the very basics of options, we will have that in the first lesson, but you can go to my website right now. I'll type it in the chat. Skiesforex.com. And I have a ton of free material that you can get the absolute basics. So yeah, I didn't want to, waste everybody's time teaching stuff that that's already there 1,000 times for free on YouTube and on the web. So hopefully I answered your question, Diane. I wanted to address that. Okay. Do I teach agricultural and grain options? I don't teach market specific options like metals or biotech or anything like that. I just teach options, and the options I teach are specific. The strategies work in any environment. If you apply the right principles, they'll work in agriculture and grain. They'll work in biotech. You just you'd have to understand the different variables of each market, but they work the same. So I don't believe in teaching sector specific because of that, because then you can only trade that sector. Do you predict range and direction of spies and Qs every morning before market open? Yes, but my class doesn't start till about 3 hours in. So yes, every single day I look at the overnight data. So the Options Clearing Corp and Oprah and CBOE, they're all publishing data, and the overnight data comes in around midnight. That is when all the data, the options trades for the day have been processed. And then they update that with the varying levels of open interest. And so I do analyze that data every single day, of SPYs, Qs, IWMs, every single day. And so I know generally where each market is going. I generally have an idea of expected range, expected volatility levels, key support and resistance levels. Yes. And I'll be sharing those projected ranges every single day with my students, but not pre-market because the class doesn't start for a few hours in. But eventually I'll build apps. The goal is with Benzinga is not just to teach this course, but to build apps that will build this into the course so that students can have access to those apps. Ray Big Rock says, I'm ready to sign up. This is a no-brainer. Looking forward to working with you, Ray. Please put the link up, sir. I think I put the link in the chat, and Rodrigo has the link up to join. Can you go over the schedule again, please? Thank you. And will it be recorded? Yes, everything will be recorded. So if you miss something, it's no big deal. So at 10 a.m. Eastern, Monday through Thursday, we'll have about a 45-minute to an hour class. Then we'll have about another hour doing Q&A on that particular lesson. And then we have about a few hour break. At 3 p.m. Eastern, we will have a market example and trade idea session where we go over, moves for the day, potential trade ideas, what I'm looking at, analyzing your trades. If you have a trade, you can just literally post in the chat live in the private members webinar. Hey, I'm looking at this option for this stock, this strike. What do you think? And I will analyze it based on my data. And I will say, this is what I think. I like this. I don't like this, this, and that. That's the kind of feedback you'll be getting every single day. And so that second section is market examples, trade ideas, open Q&A. Yeah. And then on Friday, we don't have lessons, but we have an open Q&A session. It's just an extra office hour session is what it is. So hopefully I answered your question, Tammy. Do you provide email or Telegram for Q&A? Because I'm not able to join live sessions. I live in the down under. We don't have a Telegram for the Q&A, but you can post your questions in the chat and I will answer your questions in the next class. So for example, if you miss the class or you have questions on the class I just taught, post your questions in the chat and say, hey, Chris, I have this question. Can you please answer this question? I'll be happy to answer in the next live session. Yes. Yes. We won't be sharing it via other social media. This will all be hosted within this Benzinga portal. Is this recorded? Yes, this is recorded. It'll be available on YouTube later. Brad says, looking forward to the 10th. I am well. I'm looking forward to it as well. So this is for a paid option school. Yes. Rodrigo posted the information on how to join. Sankit Agarwal, thank you. I have to attend a meeting. Good luck. Glad to have you here, Sankit. Jeff is saying, if if this is your first formal training regarding options trading, what is the next best step to expanding knowledge and continuing to learn? I know the web page is put up earlier. I would just need more of an opportunity to be profitable on the basic level prior to having the capital to continue the educational experience. Okay, so there's a couple questions in there. Are you saying if this is my first formal training, or are you saying, Jeff, can you help me out with your question a little bit? I kind of understand, but I'm not totally sure what you're exactly going for here. So if you could just help me up a little bit, that would be appreciated. If you could rephrase it, then I could readdress it. I do want to address your question. Do we have access to multiple teachers? Right now, I'm leading the Benzinga Option School. It's my hope in the future that I could train or bring in other people to work with me, so we have a host of teachers. But right now, I will be leading the Benzinga Option School. Wandu says, thank you so much. I learned a lot and you aroused my interest. I'm glad to hear. Amy says, I really like what you're saying. Your coverage on gamma and volatility are extremely essential to us. Super important. I wish I had been exposed to it when I first started options. Yeah, super important information. Dan says, can you publish the SPY and Q's predictions pre-market for your students and can teach them later? I think eventually we can. We'd have to set up the functionality for that. But eventually, yes, that would be the goal. So my goal would eventually be to build an app so that that automatically updates every single day for the students in the program. But yeah, maybe I can figure out a way to post that before the classes. Just say, hey, here's what I expect, positive gamma, negative gamma, here's ranges, here's key support and resistance levels. Yeah, that might be a feature I can add in. Maybe I can find a way to do it manually in the beginning and then eventually make it like a fixed app that does it automatically. Jerome, you'll have to ask that question to Rodrigo. Hootie Evans says, how many days are scheduled for the options class? So the schedule is Monday through Thursday. So the first week, we do lessons 1 through 4. Second week, we do lessons 5 through 8. Week 3, we start back with lessons 1 through 4. Week 4, we do lessons 5 through 8. And we keep cycling in that 2-week cycle throughout the entire year. So this way, if you miss a lesson or you miss a week of lessons, not a big deal. They're recorded and you can come back and learn about them the following week. Do we have access to Benzinga Pro for a full year? Rodrigo can answer that, but yes. Yes, you get access to Benzinga Pro as part of the package. I am mostly interested in swing and day trading. When is the schedule? We did post a schedule up. I just covered it again, Wandu. We will have a whole lesson on day and swing trading. The majority of my options trading is day trading, swing trading, maybe, out to monthly or quarterly expiries. I do some leaps for sure, but I do it all. Yeah. I'm a swing trader. Yeah, I do a ton of swing trading. So hopefully I answer your question on that. We'll be teaching strategies just for that. Posting predictions pre-market would be great. Initially, it can be posted in the chat room until you develop other facts. Yeah, we'll work on I'm going to try and work with Benzinga. We have a developer that can help with that a lot. So, it's just a question of how do we fit it into the portal, make it accessible to everybody. There's development and technical issues that we have to figure out with that. But that would be my goal, is that I can post that on a daily basis, that it's just automatic. Emmanuel, so 3 more questions on Zoom, then I'm getting to my homies on YouTube. Okay. There we go. Follow up on questions asked earlier. You mentioned that money can be made through options even if the stock price does not move. I did not catch your earlier answer on this. How can money made through options when the stock does not move? Great question. This is a great question, Emmanuel. So not all options are directional. You actually have non-directional options. It's what we call neutral strategies. Neutral strategies can be of the flavor of, hey, I'm neutral to the direction it goes. I don't care if it goes up or down. As long as it goes up or down, I'm totally neutral. If you buy calls, you want the market to go up. If you buy puts, you want the market to go down. That's a directional bias. A neutral bias would be, I don't care if it goes up or down. As long as it goes up or down and it goes a certain amount, I want to make money. But then there's also non-directional neutral strategies, which is basically, hey, if the market stays between, say, like 150 and 140, by the time my option expires, I believe the market will stay inside this range. So you could do various strategies to deal with that. There's butterflies, iron condors, iron butterflies. There's all kinds of strategies that you can do. There's straddles. There's various strategies that you can use so that if the market stays within the range or it doesn't even move at all, that you make money. So you could do what are called non-directional neutral strategies, or you can do short volatility strategies. You can sell volatility because when volatility collapses, oftentimes the stock, if there's high volatility, when the volatility collapses, the movement gets very small. And so as long as it doesn't move too much, you can make money. We cover those strategies in the course. So hopefully I answered your question. That was Emmanuel's question. Do we get lifetime membership access when we sign up? No, it's 1 year access. Do you have strategies to take advantage of the changing of the guarded options expiration? Yes, that's a big strategy of mine because volatility changes massively. And we'll get into that in like 2 or 3 slides from here. Do you teach us how to use the Thinkorswim platform? No, there's no point in you paying me to teach you how to use the Thinkorswim platform because there's free videos on YouTube to do that. So it would be unfair to charge you for something that's already free on the internet. Thinkorswim has tons of videos on how to use it. I had never used Thinkorswim prior to a few years ago. I opened it up. I spent a week and a half watching videos. By the end of the week and a half, 2 weeks, I was highly proficient at it. It's a pretty simple platform. Once you get the basics down, it's pretty easy to work with. So my suggestion would be check out the YouTube on there. There's a bunch of free stuff. Jeff says, so I'm looking at becoming familiar with programs such as Thinkorswim, studying graphs from a perspective based on volume and volatility, more so than simple candlesticks, and rehearsing some of the Greek nomenclature. These are all things I'm looking at achieving prior to signing up for class. Okay, so good. Thank you for rephrasing this here. Okay, so your first thing, familiar with Thinkorswim, just go to YouTube for that. There's tons of free videos on how to use that. In terms of studying graphs for, I think you're saying charts from perspective of volume and volatility. Again, we will teach some of these things, but that's more of a technical analysis thing. I will teach you some price action stuff, but I have a ton of free stuff on my website about that as well. So no need to pay for that. The next thing you're mentioning is Greek nomenclature. We will be covering that in the course. You can do some research, you can search Investopedia. They have a ton of free articles on it, but we'll be covering the Greeks in depth in the course. Also, I would like my hobby to become a full-time gig. In the meantime, at least pay for itself at the classes. If you learn this right, you should be able to pay for this course and then some, and then some. I had students that I started teaching a couple of years ago in options, and after the first year, they were not only profitable, but they paid for the course like 10 times over. So yeah, that's, if you learn everything right, if you really do things right, it could take you 1 trade to pay for the course. So the option school and chat room only lasts for 8 weeks. No, it's for an entire year. Every 8 weeks, we recycle the lessons again, and we go through them again. So it's 1 year access. Okay. I've covered that. Will there be any additional classes offered other than the 8 over the whole year? That will be the lesson structure for the whole year. However, as the students evolve, the material will evolve with that. So once the core base of the students have really evolved, we will be teaching more nuanced, advanced stuff in that. So yes, they will evolve over time as the core students evolve as well. Do I have one-on-one coaching? No, it's just not really a scalable thing for me because I only have so many hours in a day, and it's just not a scalable thing for me. I only have so many hours in a day to do things, and it's just I found it to not be worth it for the money that even if I charge $10,000 per hour, it's still, I only have so many hours in a day, so I can't scale up that model. And I generally look for models that are scalable, not unscalable. You can sign up for a 45-minute intro session to when you join Thinkorswim. They'll schedule you and go through the platform. That's awesome. Thank you for sharing that, Marva. NBA fan says, I asked earlier when to close SPY, SPX weekly options on the expiry day as time is against the trade. That depends. It depends on the option, depends on whether you're long or short options, depends upon where the strikes are, depends upon whether you're at exposure to exercising or assignment. There's no fixed answer to that. The market will have variable conditions every Thursday and Friday. And so, whether you're trading weekly options, we'll cover the more advanced nuances of that in the course. But that's not like something that I just answer in 5 minutes, on YouTube. So there's no fixed answer for that. And we will have an entire class just on trading weekly options in the course. Can we come back to watch this video later? I'm driving and listening on the yes, it'll be up on YouTube. Okay. Do you teach and give trade ideas on high gamma trades at expiration? I will be sharing all kinds of trade ideas. That would be some of them, but that's not like the only tool I have in my toolkit. It's not the only weapon I have. I give trade ideas based on what I think are the best options for that day. It's not like I say, okay, here's all the high gamma trades, here's all the low gamma trades, here's all the high V, low V. If that was the case, there would be thousands of trades. And, I tend to just look at that and say, okay, let's sift through, find the best trades available, and whatever they are, whether they're high V, low IV, high gamma, whatever, that will just depend on what's the setup for that day. I didn't know OPAD was going to set up on September 16th. When it came available, it was like, this is too good an opportunity to pass. Shared it with my trade members. So yeah, that's how that'll work. Can I post the YouTube link in chat? Rodrigo can do that. Okay, let's get to my YouTube questions. And I got 2 more slides and then I want to wrap it up. Let's see here. GameStop, can you shed some light on the January 21st put option open interest of 136 options for 50 cents? I'd have to go back in time, look at the option chain, look at all that. I mean, I don't know what strike. I don't know, days to expiration. There's too many variables to that. So there's no way for me to fully understand that without having more details. Justin Goodman says, I do, but just want to confirm we're speaking to dealer gamma. Yes, we were. Rockin' Razi, what is max pain in terms of calls and put options? Max pain. I think you mean max risk. So that depends on whether you're buying calls and puts or selling calls and puts. If you're buying calls and puts, your max risk is the cost of the option. Whatever you pay for the option, that's your max risk. That's it. You buy a call, whatever you paid for, if you paid $2 premium, $5 premium, whatever that is, that's your max risk. Buy put, $2, $5, that's your max risk right off the bat. If you're selling calls, well, then you technically have unlimited risk because the stock can go to infinity. And if you're selling puts, you have risk all the way to the stock going down to zero. So depending upon how volatile it is, how close or far it is to zero, that is what your max risk is. Hopefully I answered your question. Satsai says, when I buy, someone else is selling. When I'm selling, someone else is buying. Correct. But that someone else could be another trader or it could be a market maker. If it's too small, it's often offset by another trader. Sometimes market makers will take small contracts, but it's not common. They might buy them in a pool of contracts or something like that. But yes, when you buy a call, someone else is selling that call. Correct. Mr. Gunn says, where I'm getting caught up is market gamma versus dealer gamma. Dealer gamma has to do with dealer gamma hedging. Market gamma is the overall market gamma. Those are 2 different things. I will be explaining both, though, in the course. Coupons My says, how is this different from Second Sky training? Very different. And we don't offer options training anymore. We had a very basic course. But we didn't offer feedback 5 days a week. We didn't offer live training. We didn't offer trade ideas. Completely different. And we no longer offer any options courses or training whatsoever. There's a lot of material in this course that we never talked about in my old options course. And again, there's no feedback in the other options course. This course there is. Elsa Trading, for Benzinga Trading School students, will the Benzinga Pro be extended to 1 year after the Benzinga Trading School training? That is a question for Rodrigo. Yeah, ping him on that. Okay, I think I've answered most of the questions. And Ray says, I've learned a lot. I have to go. I learned a lot in a short period. This was a great class. I really hope everyone enjoyed it as much as I did. I'm glad you enjoyed it. It's glad to hear. Please give Mr. Chris Capre a hand. He is a great person to learn from. Thank you, Ray. I appreciate it. Okay. All right. So let's get back to this. I have a few more slides, and then I like to just take some final questions and wrap it up because we're almost at 2 hours. Okay. So to recap, positive gamma is when the market is net long options, and that suppresses volatility. This is the positive gamma environment. So this is how much volatility you have. You can see there's not much. This is negative gamma environment. As you can see, there's a lot more variation in the prices. There's more volatility. That should affect how you trade on that day. Super, super important. Dealer gamma and market gamma have an important impact upon how the market is going to play out for that day. Now, with that being said, I just already showed this slide. So actually, let me get back to this. So with that being said, let me show you a chart of the S&P 500. This is the SPY ETF for the S&P 500. If you look at this, low volatility environment, right? Market was in positive gamma. High volatility environment. Market was in negative gamma. We had told our students ahead of time, hey, we're in positive gamma. Don't expect high volatility. Boom, boom, boom. Now, what is so special about this day to this day? What's so special is this is a monthly option expiry right here. Monthly option expiries are tend to be the biggest expiries where the most amount of options expire and thus come off the board. And so if you think about it, if a stock has 1 million options of it and 30% of them expire on this expiry, this is the 19th. That was the third Friday, which is the third Friday of every month is the monthly expiry. And so what happens? The market opens on the 22nd. 30% of those options had roughly come off the board. So instead of having like 1 million options, now we're down to 700,000. That's going to obviously impact support and resistance. That's going to impact volatility. If the market was bullish and a huge portion of those options were calls, long calls, and 30% of them are wiped off the board, it's going to increase volatility massively. This is something that I trade often is monthly and weekly expiries. And so you can see the differences in the environments. Positive gamma environment, not much volatility at all. Negative gamma environment, huge swings in volatility. Then as we went to this environment, a lot of traders during this environment were buying put protection. They were caught off guard by the market selling off. So they start buying puts, and then they keep buying puts, and then they keep buying puts, and then they keep buying puts. The problem is that if those long puts start to go against you, if you're the trader who's long puts, you're going to close that put out really quick because it starts going the opposite direction. Your put's going to lose value very fast. And so we had a bunch of long puts in the market that had built up to a massive amount. Market starts going against them. They start unwinding those puts. It creates a rally in the markets. Now, what do you see here? Does this look like a positive gamma environment or a negative gamma? Put a 1 in the chat if you think positive gamma. Put a 2 in the chat if you think it's a negative gamma environment. Yes, Emmanuel, Tim, yes, Steve, David, Marva, Marco, Tammy, yes. Yes, I know there's a little bit of lag with my YouTube people here, but you guys are coming in now. Yes, positive gamma environment. You see this environment, you know it's positive gamma. Are you going to trade long calls? No, because those calls are going to lose money because the IV is going to come down. So what are you going to do? Trade neutral strategies. Now, I've done 2 of these classes prior to today, talking about the Benzinga Options School. And I told everybody on this day, We did a 0 days to expiration, DTE, 0 DTE, sold a straddle on SPYs. If SPY closed below 472 and above 466, we made money. What did it do? Go nowhere. We were selling volatility. Then we sold an iron butterfly for Friday. So this is 2 more days. It basically had to close inside the range for the next 2 days. I knew market it was in positive gamma. I knew volatility was going to come down. I knew there wasn't a big buildup of positions. So we sell neutral strategies, made money on that. Now, our first Benzinga webinar that we did, talking about the Benzinga option school, what did we say? We said on this day, and you can go back to the recording, I said there's a large amount of open put positions that were short dated, which is why the market sold off leading into FOMC. And what did I say? I said on this day right here, is actually this day right here on the 15th. Well, no, 15th. It was the day before the FOMC. What did we say? We said a lot of the people who bought this long puts right here over the last 2 days, this is where we saw a lot of short dated puts. If the FOMC comes out positive, they're going to close those long puts. That's going to create a rally. What happened? FOMC didn't spook the markets. We had a rally because all those long puts got out of the markets. So we said that on the first webinar. Then we did a webinar on the 19th. And what did we say? Markets seem set up for a Santa rally. Volatility, I made 2 predictions at the end of the webinar. I said volatility should increase. And I said the markets are set up for a Santa rally. What happens? Volatility increases massively. It's a huge expansion in volatility. And we got a Santa rally. We said this ahead of time live in the Benzinga webinar. And they happened both times. Why? Because we understood market positioning. We understood market and dealer gamma. We understood the flows. And we understood how the changing of those flows would impact the markets going forward. So super important that you learn to read this. If you had followed our trade recommendations from the last 2 webinars, you would have made a lot of money, maybe even the money to pay for this. So with that being said, why did I expect volatility to increase? I expected volatility to increase because December monthly options expiry. So the December expiry was on the 17th. That's this day, the 17th. Okay, that's 17th. We did it on the 19th. So we did it in between on a Sunday. We knew that there was about 30+% of the SPY and SPX options coming off the board. And so because of that huge amount of options coming off the board, that tends to increase volatility in the monthly OPEX. That's exactly what happened. So yes, hopefully I answered your question. NBA fan says, will you share your trades during the trading sessions if I take any trades? I haven't decided whether I'm going to share like the exact, like, hey, here's my entry, stop loss, and take profit, but I'll be sharing the trade ideas that I'm taking every single day. The problem is if I share all of the exact trades, then you guys are going to take them and you're not going to learn. So I have to find a fine line between sharing trade ideas and sharing the signal itself. So trade ideas, yes. Will I be sharing all the exact signals? Maybe. I haven't fully decided if I'm going to share all the details or some of the details. Like I might just be like, hey, I'm long straddle or short straddle on this. Here's my strikes. I might do that. Or I might be like, hey, here's my strikes. Here's my stop loss. Here's my take profit, you know, this and that. So I haven't decided how far I'm going to go with that, but I am going to be sharing trade ideas. Like OPAD, I shared the trade ideas with my members. I will be doing the same thing with you guys. Iron condor is good for positive gamma in the right environments, but that also depends upon direction and where the positions are building. Sometimes it won't be because sometimes there'll be a directional bias to that positive gamma that is worth trading that direction. So there's not a fixed answer on that. Is the orange line the VWAP? How do I use it? I do use, that is a VWAP. I have videos on YouTube on how I use it. It's not something specific that we need to cover in the course because I already got free videos on it. Brad says, you have been spot on. That is why I signed up for your course. What's up for the rest of the week? Great question. And then we'll answer Jeff's question. And then I've caught up on YouTube. Jeff's question is, how much capital would one recommend one would need to go into the class prepared? My suggestion is on the low end between $1,000 and $5,000 account. It's not so much that you need boatloads of capital. Like I'm not going to say you need 100 or 250 grand or something like that to do this, because with a small account, you can still trade a lot of options and you can still practice a lot of options and get the experience in them. And that's really the most important thing. By getting repetitions in, by getting experience in, by getting feedback from the markets on how you do, that will really help your brain to learn faster. Repetitions, experience, your level of focus, these all things matter in terms of neuroplasticity, in terms of the ability to wire in profitable habits into your brain. And so it's not so much the size of the account. I know traders who take $2,500 accounts and turn them into $25,000 accounts in a couple months. And then they withdraw the money and they start back over again. So you don't need a huge account. It's not like you need a fixed account. Everybody's going to be different. As long as that capital is capital that you can risk in the markets, and it's not going to like take away your mortgage payments, or you're not going to be able to pay your bills if you lose that money. In other words, it's capital that you can afford to lose, in the sense of like, hey, I'm using this as a learning experience. I may make mistakes. I may lose money. I'm not going to not pay my bills because I'm doing this thing. Then you're fine. So it should be disposable income. That doesn't mean we want to lose it. We want to be careful with it. But as long as you can put 1,000 on the low end, I think you're fine. Yeah. NBA fan says, I learned a lot from your sessions. Very helpful. Thank you. I'm glad to hear that. Okay. So getting to Brad's thing, where do I see things going forward? And by the way, anonymous, again, anonymous attendee, if you can post your questions in the chat, I'll answer it there. I'm just not looking at the Q&A. Okay. So what do I see going forward for the S&P 500? So what I've been seeing over the last few sessions is an increase in positive gamma. And so, we're kind of in this environment of lesser liquidity, so it's holiday trading right now. Like I'm done trading for the year. To me, it's not worth it to, like, I could add another 1 or 2% or maybe 3% or 5% to my bottom line, but that's not going to make or break my year. And so, but all it takes is one low liquidity event for the market to spike 3, 4, 5 handles, and I could lose a lot. So I'm not really trading the rest of the year. But if you want to, as an exercise, as practice, well, then here's what I see going forward. I've seen a buildup in positions, particularly in call positions, above the current strikes. Let me go to SPX. It's a little bit easier. So I'm seeing a lot of buildup in positions, particularly calls targeting this 4,800. We're going to hit 4,800 this week. Unless some new catalyst event happens or something like that, we're going to hit 4,800 this week. I haven't seen the overnight data. I won't see it till tomorrow. But if I start seeing buildup of positions above 4,800, well, then that will increase the positive gamma even further. That will also increase the bullish bias even further. But because we're in positive gamma, it's going to suppress volatility. And so I don't expect the markets to be immensely volatile this week. I expect them to be relatively subdued. And so, with a bullish bias. And so I'm seeing now support levels are building up. I haven't seen the overnight data, but support levels are building up to now where 4,700 should offer support on pullbacks. 4,707 all the way up to 4,730 should offer support on pullbacks. In terms of SPYs, you can do roughly the equivalent on that. 476 is roughly 4791 in SPX. SPYs is the retail ETF. SPX is what institutional traders trade. So I think that SPY probably stops right around 478 to 480 tomorrow. I don't expect it to be as big a gainer as it is today. What did it open at today? Opened at like 473, closed at 477, 4 points. That's a strong day. And you could see it was just consistently being bought. It was consistently being bought because a lot of the fears have been taken out of the market. We had the monthly expiry. We've had the FOMC. We had a major VIX expiration. We've had no new catalyst come in to put fear into the market. And if you look at SPYs, you can see VIX has been crushed. As long as VIX keeps getting crushed, then SPYs should go up. I think SPYs probably stay strong the rest of the week. That means that if it dips, I'd want to buy it on dips, especially if it's not like an aggressive dip. If it's a corrective dip, where it kind of just slowly chops back, then I'll be happy to buy. I think buying SPYs between 472 and 470, if it dips there this week, I think it's a great buy. I'm bullish on SPYs, positive gamma environment. Volatility should be like SPYs should not move open to close, 4.5 points tomorrow. It should be less than 4.5 points because the positive gamma just keeps building. So the one concern I have, and it's not really a concern, it's more of like the fuel to the upside might start running out, is that VIX is starting to get low. Once VIX starts to get into this kind of 15.5 to 16.5 range, there's only so much more that you could suppress VIX to help boost SPYs. So I think once VIX kind of gets into this 15.5, 16.5 range, then you'll probably see SPY consolidate more of its gains. But bottom line is positive gamma environment should be supported. That means you buy on dips. You don't expect it to rip too high outside of a new catalyst. And there's an overall supporting of the prices. SPX, it should hit 4,800 tomorrow. And if a bunch of calls come in on the overnight data saying, hey, calls are extending to 48.25, 48.50, then that could pull it up a little bit further. So that's my prediction on that. SPY 483 by end of the week, possible. Again, that depends on how quickly VIX gets down to here. I mean, you can only crush VIX so much. And so if you can't crush VIX anymore, then there's that implied that IV crush is taken out. Like as IV goes down, positive gamma tends to build up. People tend to get long options. But if there's no more of that fuel, then you take away some of the fuel for the markets going up. So it's just a question of, could it hit 483 by the end of the week? Possibly, but is it going to close there? That's the more important thing. How can first-time investors get approved for options trading? You'll have to talk to your broker about that. They're generally going to ask you questions about your experience, your skill level, and things like that. Again, I never had to go through that because they just approved me for level, the highest level possible from day one, because I'm a more sophisticated investor. Nice market for a new guy. Yes, positive gamma environments are great for new people. They're great. What's the difference between volume and open interest? It's a great question, David. Volume is just the number of contracts traded on the day. Open interest are the contracts that are unsettled. So you could see volume on the day, but the volume could have reduced the overall open interest. Or you could see volume on the day and the volume could be increasing the open interest. So open interest is the number of contracts that are unsettled at that particular strike. Volume is just the level of transactions that happen on the day. Since VIX is low, buy VIX, buy equals. Yeah, I'm not exactly a fan of trading VIX directly because it's not the most liquid instrument. I'd rather just trade SPYs. If I think VIX is going to go up, then I would rather short SPYs or sell some calls on SPYs, assuming I'm long SPYs. So I'd rather trade that, or, you could buy some puts as protection, and which is probably a good time if you thought that's going to be the case. But I don't recommend trading VIX directly. It's a lot less liquid. Like the number of VIX contracts versus the number of SPY contracts, not even close. You get better spreads, you get better pricing on SPYs. Yeah, that would be the better way to trade it. Any more YouTube questions? Okay, so I think I've covered the majority of what I wanted to. Dan says, I'm long Qs. Do I stay long over the rest of the year? That's your own individual decision. You should have made that decision before you got into the trade. If you're asking me, do I think Qs are supported? Yeah, I think Qs are in a very good position. I'm just not sure how much more room they got to go. I'd need to see the overnight data. Prior to today, I was looking at my data. Prior to today, I felt like and I don't have the most recent data, but prior to today, positive gamma environment. Qs had a little, I don't know if they were a negative gamma going in today, but they had more room for volatility. But I'm willing to bet that after the overnight data comes in, that's probably likely that a lot of people bought long options on Qs, long calls. So it probably have reduced the positive gamma. I'm just not sure how much more room Qs has got. And so, you have to make your own trade decision based upon where you're long. Do I think Qs has a little bit more room? I think it could get up to 405 or 408. But as the market gets more and more long positive gamma, volatility will continue to get suppressed. So you got to weigh that and see how much more upside there is. Java has a question here. Java Mocha Frap. If a stock goes up 5%, how much percent does an at the money option move? That's not a fixed answer, because it's going to be dependent upon moneyness. So option pricing is going to be dependent upon moneyness, volatility, and time to expiration. So there's too many. It's not a fixed variable. That's not a fixed variable. It's going to depend upon the gamma. Obviously, the gamma is the rate of change in delta. There's too many variables to answer. It's not a fixed answer. Dan saying, thank you. What I meant is that, do you think Q is running out of steam? No, I think they're all pretty supportive right now. I like being long options right now. And if I get mild dips and no new catalyst, I would buy. Like, I'm not trading this week, but let's just say I was trading this week. If I got corrective dips, mild dips on SPYs and Qs, I would buy. Yeah, I did. I set up all my options because, again, we anticipated this ahead of time. We said the market is set up for a Santa Claus rally. So the last week, we did all our final options for the rest of the week. We bought an AMD broken wing butterfly. We bought a SPY broken wing butterfly. I'm trying to think. We bought some Ford options. All of those have gone up since last week and this week. So I'm not doing any more trading this week. I told my students, and if you guys were my students, I'd be telling you this. I'm like, look, and let me put it, I'll tell you exactly what I told them. So I told my students this week, I said, okay, this is what I said. Liquidity will be low and spreads will be high, and this will get worse as the week goes on. This generally isn't the best for trading. The money you make this week will be immaterial to your overall P&L for the year or your financial resources, but the losses you make could be material because of liquidity, and you can lose weeks of gains in a few days. At some point next year, you'll want to take a break from the markets. Is it better to take a break during these times or better to take a break when the markets are in a normal state? I think the answer is obvious. In my opinion, this is a great time to study, learn new methods, refine, analyze, integrate, and plan for the next year. If you're trading, you're likely not doing that. This is just my thoughts. So that's what I share with my students today. And this is what I would be sharing with y'all if you were my students. So again, the money you make this week is going to be immaterial. You're not going to buy a Ferrari with the money you make today. Maybe 1 out of a million people gets lucky, but it's unlikely going to happen. Bet that it's not you. You may make some money this week, but if liquidity gets low and spreads start to widen, you can lose a lot of money really fast. Is it worth it? I don't think so. I have some trader friends. I have like one trader friend. He's up about 4.5 million on the year. He's still trading this week. And I'm like, dude, why are you trading? Like, okay, maybe you make another Porsche by the end of the year, but that's not going to mean anything for you. Whereas if you have one big losing day, you can wipe out a lot, so I just don't get it. I think, if you want to take time off, now is the best time to do it. Trading is generally a 52-week year job. We rarely ever get weeks off for holidays. Use these while you can, because you're not going to get many weeks like this in the future. Okay, let's go over the last few set of questions, and then I'd like to wrap it up. Oh, and this is just, I already showed this data on why you should be trading options. Okay, so do you favor trading SPY over Qs? It just depends on what their overall architecture and structure is in terms of the flows. Sometimes SPY, sometimes Qs. I've made money on both. I make money on spies and Qs. Prior to 2 years ago, I made no money on spies. But then as soon as I started applying my new option strategies to it, I started killing it on spies. So I love spies now. Spies has better liquidity, but lesser volatility. Qs has lower liquidity, but greater volatility. So you really just have to choose. Sometimes spies are in a better position based upon the flows and architecture of those flows and the gamma. Sometimes they're in a worse position. So you just have to kind of feel it each day and look at the data. How do we know market is positive or negative gamma? Unless you have a special program or app that collates all the data of all the options contracts and all the gamma at the various strikes, you won't know. I have that program. And so I will be sharing that, like when my students are like, hey, are we in positive, negative, gamma, and spies? I will be sharing that every single day. Eventually in the future, I'd like to build an app that's built into Benzinga Pro that shows that information. But for right now, you won't know. It's not publicly available. You have to buy an app or pay for the service to collate that data. Is it best to get in the money or out of the money on puts or calls? That depends upon the pricing. There's no fixed answer to that. As a basic general recommendation, I generally recommend trading in the money puts and calls if you're going to buy those puts and calls. But there's no fixed answer to that because of where those strikes are at support or resist. Are they at support or resistance or away from it? Is there good open interest in there or not? Is there hedging impacts at that level or not? So there's no fixed answer to that. If you want a very basic rule, you're probably better off buying in the money than out of the money. But that's a very basic rule and it's not nuanced at all. And I wouldn't consider that like the most reliable for every situation because each situation is different. We will teach you in the school when to be buying in the money and out of the money. Amy Masuda says, do you teach how to exit strategies of options when the situation changes with the delta and gamma? Yes, we'll be teaching that. Do I trade calendars? I do trade calendars, but I don't recommend students trading that until they have a fair amount of experience. To trade calendar spreads, you really need to understand term structure, volatility. There's all kinds of things. And I think there are better strategies to trade besides that. So that's a more advanced strategy. So not until you've had, maybe 1,000 trades under your belt, you're profitable, you really understand options and strategies, and you understand volatility term structure. Tammy says, since we get Benzinga Pro, how do we learn to use that platform? Will you be going over this? No, because they have a ton of information and free videos on that. There's no point in you paying for something that they already offer for free. So I will teach you how I use it or how I have mine set up, but I'm not going to teach you all the features of it because it's an immense program. And the focus of the school is Benzinga Options Pro, is Benzinga Options, not the Benzinga Pro app. But I will teach you how mine is set up. Simar says, is there a certain percentage delta which is considered as a safe play when buying calls, 40%, 50%? If you think about it, if you're buying a call that is 50%, if the delta is at 50, well, then it's relatively considered an even money that it could go up or down. So you actually have the greatest amount of uncertainty. Try not to think of delta as the percentage chance that it will be profitable in the money. That's not really the most accurate way to assess it. We will go over that in the Benzinga Options School. We have an entire section on delta, but I don't look at delta as like, oh, it's 40%, it's 50%, this is safe, because it could be safe in terms of the percentage, but you might be buying an option, a long call with a 50 delta right at a major support or resistance level that's going to reject it. And so technically it could be safe, but then there are other variables that could be like, no, this is not safe. So try not to think of delta as like this fixed percentage that, oh, this is safe, this is not safe. Each one is different. Yeah. Do you trail your stops with options? I do not. I do not trail my stops with options. I trade all of my strategies, each one individually. I know exactly how I want to trade each one. And if the market adjusts, I know exactly how I want to adjust it going on, but I don't trail with stops. It's like, I want to be in or I want to be out, and that's it. How How wide is your spread for a decent entry? No fixed answer to that, online business, because that's going to depend upon strikes, premium, IV, all that matters. You should never have a fixed width in your spreads. Like if you're doing a bull call spread or bull put spread or bear put spread or bear call spread, you should never look at a fixed strike, because that's not taking in the information of the Greeks or the pricing of the options. Sometimes you look at the out of the money strikes, $5 out, and they're priced great. Sometimes they're priced, very low. So it's not worth it to sell, the further out of the money strikes or something like that. So you can't look at that as a fixed thing. Yeah. Kongxi saying, among all option strategies, which one is the most profitable for you? I don't break my, because I trade probably, I don't know, maybe 12, 14 plus option strategies. It's not really worth it for me to say which one's the most profitable, because I'm using them in different environments. And so it's not really worth it for me to go through each one and be like, I make the most money on long calls versus long puts, because I might be using long calls in a situation that I won't make as much money in long puts, or I won't make as much money as a ratio spread. It's more of, am I maximizing the opportunity available with that option strategy? Could I have used a different option strategy to make more money in that situation? That's more important to me, because I use options for very specific situations, very specific structures and price patterns. And those patterns may have more or less profitability built into them. Certain patterns might have the room for the market to really rip, whereas others might not, because they're really more for a positive gamma environment. So it's not really worth it for me to analyze each individual strategy and then be like, oh, I make more on iron butterflies versus long calls. They have different applications. The real key is, how can I make the most money with the right strategy for that environment? That's the real question. Yeah. Okay, I think I've answered that. Tammy says, so is this school all year long? Yes, it's 1 year. It starts January 10th. So hopefully I answer your question. I love the way you teach. Thank you. I appreciate it, Tammy. That's awesome to hear. I really appreciate the feedback. Okay, we are 2 hours and 20 minutes in. Oh, Brad has a question. Do you still trade stocks, or are they boring for you? No, I still trade stocks. Sometimes it's better to be long stock than the options. It just really depends upon the situation. So as you learn the nuances of each one, you'll realize, hey, it's better to be long stocks versus long options. It just really depends upon that. But yeah, I trade them both. I still trade them both very actively. Yeah. Okay, Rodrigo, I am going to wrap it up for this. I've covered everything on intro to option trading principles. We've talked about how I think traders should learn, what is my overall framework for understanding options? How do we understand flows? How do we use this to our advantage? How do we use volatility? I gave some examples of prior trades that I took, prior recommendations I mentioned, which, as Brad said, were both spot on. And I've also made some kind of predictions for what I think is going on in the market going forward. But yeah, we've covered a lot, and I hope to have you all be a part of the Benzinga Option School. It's going to be an amazing opportunity. Again, if I had this opportunity 21 years ago, I would have paid 3 times as much for this, because it would have saved me time and money that I spent years spinning my wheels on strategies and things that didn't work out. And I had no mentor to give me feedback back then. And now you have that. You imagine getting this 2-3 hours every single day, Monday through Thursday, Monday through Friday. It's amazing. So I would have paid a lot for this. And so I hope you guys enjoyed something today. I hope you learned something and appreciate our style. And so with that being said, I hope to be working with you all in the future.
Absolutely, Chris. Thanks so much for being here. We appreciate it. Something that we at Benzinga, and also a lot of the current option school students, and all of the new members that are going to join here today. So appreciate that, Chris. Do you have any closing remarks you want to leave the folks with, since we're about to finish off the year here? Maybe some remarks overall.
Yeah, and this is kind of what I was saying earlier, which is like, look. If you think about professional athletes, they have a season and then they have an off season, and that off season is important. It's time for them to rest, to spend time with family, to heal, to kind of prepare for the next year. In trading, we don't really get that. And now is that time period. This is the best off season you're going to get as a trader. It's a 52-week on year. And that is both good and bad in the sense that we as human beings, our brains need time off to integrate information. We need time off to learn these skills. We need time off to review, to analyze, to practice, to get repetitions in. Now is a great time of the year to be doing that. And now is a great time of the year to be preparing, to join the Benzinga option school or just prepare for next year. Set your goals, analyze your data for last year. What were the mistakes that you made last year? What do you need to improve on? What skills are strong? What skills do you need to work on? Now is a great time to do that. And the thing about that we're seeing in the markets now is options are becoming more important than ever. You saw the data. There's more options, single stop options, contracts being traded than shares. And as this education gets out more and more, that is only going to increase. But the thing about it is options is not as simple as like checkers. Like checkers, you can only move so ways. Options is like chess. I'm not saying you have to learn to become a grandmaster to be great at this. You don't have to be. You don't have to become Gary Kasparov or Magnus Carlsen to make money trading options. You just have to become good enough. And even though it's a little more nuanced than stocks, it gives you way more, no pun intended, options to make money. And so if I could start my career over, I would teach myself options from day one. And I couldn't even imagine what my career would be like today if I had started with options on day one. And if I had started with a Benzinga option school or anything like that back in the day, I couldn't even imagine where I'd be today. And so I hope you guys use this opportunity because options are going to have a massive impact upon the markets next year. And it will help you to, by learning options, we'll start to pull back the curtain on how the market really works. We're going to be opening up the hood and explaining how the engine and how all these parts work so that when something breaks, you're going to be like, I know how to fix it. I know what to do. Here's where you do this, this, and this. You apply the right tool for the right situation. And we're going to be doing that. Once you learn how to understand option flows, you're no longer going to feel like you're reacting to moves. You're going to feel like, hey, this is going to be a volatile day tomorrow. I'm prepared for this. Here's what I'm thinking about doing. You're going to have a game plan ahead of time. Or, hey, this is going to be a low volatility environment. I shouldn't expect the market to rube 10% today. This will pull back the curtain on the market so that you start to see the market in a way you never did before. And once you have that, you're going to feel like you will not be the same trader. What you come out of this school, you will not be the same trader than what you started with the school. And so that would be my final comments. I hope you guys use this time and opportunity well to study, to analyze, and spend time with the family and those you love. I'm enjoying it, spending time with my girlfriend, my dog, my cats, and everything like that. Use this time to rest and relax, to prepare, because next year is going to be, I think, an amazing year. And for those who are empowered with how to understand options and apply it to trading, you're going to have that much better a year than those who aren't.
Wise words there, Mr. Capre. Thank you very much. Appreciate your time here. Thanks for coming in. And, we'll be doing this as well. I'm pumped. January 10th, we are going to be there live Monday to Friday, Chris Capre, with all the students there. That's going to be fun. So I'll see you there. And I'll just stay here for a couple more minutes, just answering questions on the subscription and all that stuff. But it's great having you, Chris. I appreciate your company here always. So thanks for being here today. Absolutely.
Good seeing you and great seeing all the students on YouTube and Zoom. Take care. And I hope to be working with you soon.
All right, guys, there you have it. Chris Capre, amazing presentator. This guy knows his stuff so well. I can't wait for the school to start. I'm really excited. January 10th is the official day. Guys, right now is the time if you have questions about the subscription, about, 7-day money back guarantee, all that stuff. If you have pro, blah, 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 just keep the questions coming. If you have any, right now is the time. I'm just going to briefly show you guys the syllabus in case you didn't watch it. And if you just joined, you just missed out on an amazing presentation here with Chris Capre, Chief Educator at the Benzinga Option School Grand Debut, starting January 10th. These are some of the these are the chapters we're going to be seeing, but we're going to be seeing other things, right? So it's one, you'll be going over the whole 8 chapters in 2 weeks. Monday to Thursday, you'll see 4, Friday recap. Next week, Monday to Thursday, you see 4, Friday recap. Keep in mind, it's just like, you're going to one class of the entire chapter, right? That doesn't mean you're gonna be a professional in, in 3 and 4 legged option strategies if you just go to one class, of course, right? And we ramp it up as we go, as people pick up, because we want everybody to be on the same page or as close as possible. No trader left behind. That's our policy. So we apply that to our educational format, guys. So these are the chapters that you'll be seeing as you progress through the courses with Mr. Capri and the other students. You will be able to have more in-depth and detailed conversations of the chapters being discussed, because there's so much into it, when to use it, when not to use it. And you're going to be able to have a better conversation. The number one thing is to know what you're going to be discussing and really understand it before you can have a smart conversation about, with that about someone. So these are the main chapters. Keep in mind, there's other things that you're going to be discussing that we didn't make a full chapter on, but you're going to get a lot more golden nuggets and secrets and like tips and tricks and things like that that other people use, and just advice that has helped people that have been trading for a long time. So if anybody does want the syllabus, send me an email. I'll put the contact below. Send me an email and I'll send it to you right away. If you do want to check this out on your own. Okay, this is the class schedule. 10 a.m. Monday. So Monday to Thursday, you have the same thing. 10 a.m. to 10:45, you have the lesson lecture. This is all in Eastern time. Okay, I'm highlighting that right there. So something different so you don't get confused. All right. Eastern time. That is where everything is going. Monday to Thursday, it's the same thing. You're just going to have a different chapter. And there you go, from 10 to 10:45, lesson lecture. So you're going to go over the lesson, whichever one that you're going over that day. Then from 10:45 to 12, you have a full lesson Q&A, current market examples, everything that you're going to learn from Chris Capre. He's going to be showing you like a real chart, not some 1950s chart, of like GE. We're going to be talking about current market examples. How do we apply the data? How do we apply the information, the strategies, and profit from them within the trade? And you're going to have the chat room as well for trade ideas. So till 12, right? You're going to be doing that with him. Lesson Q&A, current market examples. And these times are not set in stone. So if you guys have more questions, if you want to interact more with Chris, if you have, other things you'd like to know, feel free to know. You can do that. We won't tell you to leave at noon, or whenever the time hits. It just depends on the participation. And from 3 to 4, you have a lesson review and an open market discussion. So that means that you're going to review the lesson completely, right, after the Q&As, and you're going to have a full discussion on the market, any questions you have, how you can apply the lesson to other parts of the market or other stocks that you're looking at. So that is going to be the typical day. You have some time in between. 3 to 4 p.m. is the best time for the review, especially for options trading, because at 4 it's closed. Then Friday, you have a lighter day from 1 to 2 p.m. That's all you're doing, 1 to 2 p.m. Class reviews and open student Q&A. So if you cannot attend any of these classes, they're all recorded and they're all uploaded in the portal. So I know more or less how the structure is going to be of the school. I can show you a mock if you guys want. This is not the actual options trading school. Okay, I just want you guys to keep that in mind. This is something how it's going to look like. Okay. Let me get this shared on that screen. 1 second. Okay, so I'm just showing you a mock of how the options trading school is going to look. Okay, you're going to have, this is going to be the homepage. Okay, these are not the classes for the option school. This is just a mock, all right, for just to visualize for you. Let me know if you can see that, if that's pretty clear for you guys. Let me open the chat. Amy, let me put in the contact there. 1 second. All right, Amy, yes, send me an email so I can send you the, I can send that to you. Mariola money back guarantee 7 days. So you have full 7 days. If you like it, don't like it, you get the money back. Um, this is all Chris Capre. Chris Capre is the chief educator of the Benzinga Option School, Mr. Tim. Um, Dan, hey, what's up, man? Um, so how does this work? The course is 2 weeks. Well, not really, man. Emmanuel, education is a lifelong process, right? So, I mean, Chris Capre has been doing this for over 2 decades, right? So we're doing our best to really get you up to speed in general, right? So like keep in mind you going to one class for those 2 weeks, I don't think that's really going to make like the big difference. It's really sticking to it and going through the education, because it's always going to change. The market is always going to throw a different wrench and a different sort of news, a different sort of catalyst, a different sort of economic situation. It's never going to be the same. We don't, like, so it's always going to be a different scenario. So that means that as the days go by, as the education goes by, even if the subscription's for a year, but that doesn't mean that next year you try to do that on your own and you start doing things, unlike what Chris Capre would, show you on the school, right? So you have freedom to trade, obviously, but if you're not sticking to the guidelines, so that's something different. So after the 2 weeks, all right. So when you take a class in college, Emmanuel, you have a class for, let's say, a full semester as an example, right? So you take the class on Monday. What happens next Monday? You take the class again, right? And you keep taking the class, so forth, and you advance on the material until you actually feel that you're at that point. So unlike college, we don't punish you if you're not able to, like, get the courses done. Like in college, after you fail a class 3 times, you can't take it again. You're welcome to take all these classes as many times as you want, because they're going to be uploaded and recorded for you to watch them. So you're going to have that flexibility on the schedule if you have a 9 to 5 or something like that. Tommy, send me an email, and I'll send you the syllabus. Amy, I put the contact below. Can you see it? Okay. So I'm showing you a quick mock of how the options trading school is going to be. Again, this is not the options trading school. Okay. I'm just giving you an example, a mock of how it's going to look like. This is the homepage. You're going to have all the classes here, recorded, all the Q&A sessions, all of the office hours. Every single chapter is going to be recorded and uploaded, so that all you have to do is come in here and click. All right. That's the homepage. You're going to have a section here that says live class on the left side where I'm clicking. All right. And then this is where you're going to have the class, and then everybody's commenting about the actual lesson. Like, hey, I don't get this, or hey, what do you mean about this, or whatever it is. This is where you will post a comment related to the actual lesson. And you can even put like a thumbs up, and it's super, you can even respond in the same thread. So there's a lot of upgrades here that we've created. This is all Benzinga technology. This is not Discord. This is not Reddit, boards, nothing like that. This is all Benzinga technology that we created for you guys, and we're going to continue developing it. Then you have the video library. This is where you find everything. This is where you find absolutely every single recording. This is where we'll go. So another place where you can find the information, right? And keep in mind, we always go through, well, in the lesson, Mark will, like when you have a question, you can always ask it. There's no like forbidden questions or nothing like that. Then you have a chat room session where you can see you're going to have a chat room for students. Okay. You're going to have a chat room for the instructor. You're going to have different sort of chat rooms, general discussions, all that sort of thing, where you can basically have that communication, right? So all of that is going to be included. This is just a mock-up of how the options is going to look like, but it will be starting on January 10th. So, just to keep in mind, the portal is going to open January 10th, right? You will get access to Benzinga Pro right away. That's not something you're going to have to wait or nothing like that. And feel free to drop the questions, guys, before we do close the stream here in a bit. I know it's New Year's. I know everybody wants to go out and do the thing, but make sure you take care of business here, guys. All right. Make sure you take care of business with trading. So I'm going to leave my contact here. If you have questions, please email me, call me. I'll be more than happy to help you. You can call, email, whatever works. I'll be around. and join the school. Join the school. It's so great. 7 days money back guarantee with a verified professional trader, 72% gain P&L on 2020, the most insane year in the world. When everything was falling apart, I think I'm good with that. And I will be attending the classes. I'll be going over, checking in, because the material is going to be great. Huge value for retail traders as well. Understand the overall industry of options, not just, what is a call and a put. So without anything else, guys, I don't see any other questions. So I'm going to go ahead. I'm going to close the stream, guys. I'm putting, Country has a quick question. All right, let's go to the YouTube questions. Country, are these scheduled times? Is there a time that I need to block off? Well, these are all the times. So this is how the schedule is going to be, Country. It's going to be 10 a.m. to 10:45 lesson lecture. I'm sharing it in the screen. Let me see if I can make it a little bit bigger. If I can zoom in. Okay. You see that? The class schedule. Monday to Thursday is the same thing. It's the same schedule. From 10 a.m. to 10:45 a.m., you have a lesson lecture. Okay, that is the actual lesson. That is the actual lesson. That is where the teaching will be happening. Okay, 10:45 to 12 p.m. That's where you're going to have the actual Q&A of the lesson. So make sure you jot your questions down. Make sure you're jotting down things you get, you don't get, and maybe any specific examples that you might want to point out that you want to discuss. Like, hey, Chris, do you think that applies in this particular scenario? I'm looking at something similar. Yes, no, for whatever reason. You create a discussion, right? That's how you learn, right? So then you have a break, and then from 3 to 4 p.m. you meet again. You have a full review of the lesson, and you talk about the market, full open market discussion. Anything that's on your mind about a trade or something that you're asking that you need help with. And this doesn't include the office hours. So yes, you guys are getting spoiled. You guys are getting spoiled big time. Seriously. All right, Country. And then on Friday at 1 to 2 p.m. Okay. You only meet from 1 to 2 p.m. You have a class review, right? Class review and open student Q&A. So that means that you're going to go over everything that you saw from Monday to Thursday, all of those 4 chapters. So you're going to have Friday to just do a full recap. And keep in mind, the office hours are not included here in the schedule. All right. So I'm going to leave this here for you guys a bit so you can take a look at it. And let's see, Country. So if I have a 9 to job, this class won't really work. Well, not really. A lot of people that join the school do have 9 to 5, right? Because ultimately, if you're not really profitable as an options trader, you don't want to do it full time, right? And you do want to know that you have experience and you have some knowledge under your belt that you'll be able to, to go through the time. So a lot of people start like that, but the most important thing is actually starting and learning, right? Because if you don't know how you even make the money, you're going to lose it just as fast and easy. That's just how it is, for some reason. Like, if you don't know how the hell you made all that money, like, how are you going to know not to lose it? So some people are lucky. Other people, they really know they have a niche, but ultimately education is really where you need to go. That's what makes people, who they are. So what is there before January 10th? Coupons. So right now we do have the open enrollment at this moment in time. I don't know by January 10th, but I do know that it's going to be starting January 10th. So here's my advice. If you do want to start, do it as soon as you can, because by the time January comes, it's my understanding that prices will be higher. Okay. So every end of the year, there's always repricing companies do. So you have the discount for today. It's going to be valid till midnight, I believe. And basically you're going to get Benzinga Pro. You're going to get the full option school. You're going to get Chris Capre's trading idea setup chat room, where he's going to be posting setups and, possible trade ideas that he's looking into. He's going to determine how he's going to give that to you guys, but that's what it's for. And then you also have the student trade idea chat room, where you guys can talk amongst each other. Chris can come in and chip in there when he feels like it, and talk about that stuff with you guys. So coupons, what you're doing is that you're saving your seat, right? You're saving your spot in class, pretty much. So yeah, that way you can at least know for sure you have your spot, you have your seat. It's not like we're gonna have 15,000 people in this. So yeah, that's what you're doing before June 10th, before it officially starts. And if you want to learn, you learn with the class. It's like you're starting a course in college and you're like going in there when it's already 3 months in. Like, we have to be realistic. So if you do have the chance, right, because you can't go back in time, if you do have the chance, get ready before January 10th when it starts. So prepare so that way you're ready, you have your spot, your seat, your price is locked in. It doesn't matter if it goes back to 4 or 5,000, you're still going to have the same price. It's a lifetime discount. So every year when it renews, you pay the same amount. It's not going to change on you. Now, even if there's inflation. All right. We had a 7% inflation and it's still the same price. So it doesn't matter. Even if we have inflation or deflation, it's going to be the same price. You're going to be locked in. Okay. Tim, you're good. No worries, man. Is there an option for those? Geoff, you're gonna have to send me an email. See what we can do. We'll see. All right, guys. It's been great here being with you guys. Let me put that for you, Geoff. I'm gonna put my contact there one last time, guys. Okay, and the link. I have some emails I have to respond because you guys are sending some now. So I'll be available for some time. Guys, thanks for joining. Thanks for being here, for being part of the community, for showing such a great energy. Always. It's amazing to see that. It's great that you guys are able to do something like this, the option school, something that did not exist a while ago. And now, things are changing, right? Benzinga is leveraging the playing field. We're helping retail traders get ahead. And, we enjoy doing that. That's part of our mission here. So guys, thanks for being here. Have a great day. We will see you on the next time. And don't forget, if you have questions, call or email the contact that we put on the chat. All right. So thanks a lot, guys, and we'll see you next time.